quorum and are ready to proceed, so we'll turn it over to you, Charles.
Good morning and thank you. We have a long day ahead of us, so I'm going to move straight into the performance review for MDC and ORP. Alex Ford is here to cover that for us.
Thank you, Charles, and good morning, committee members. It's a pleasure to be with you today. So we'll do a brief overview of the MDC through the end of September. And if you have that book in front of you and would jump to page 18, we can start with a review of the asset allocation. So the pie chart in the table below just reconfirms that the MDC offers all of the main asset classes, including a brokerage window for any participants who may need some additional fine tuning. The total value of the MDC you see at the bottom of the table, over $2.5 billion as of September. That's up over 138 million from this time 1 year ago, really driven by strong market returns, particularly strong equity market returns. And we can see some evidence of that on page 19, where we look at the cash flow and asset balances over the quarter. Moving from right to left, you can see the growth in the plan, really driven by two sources, one being the investment return and the other cash flowing into or out of the plan. Now, as is typical quarter over quarter, there is negative cash flow associated with this plan. So more money coming out than going in, but strong market returns have outpaced that for much of the last couple of years, continuing to push the market value higher. In fact, if you go down that investment return column, you'll see across all of the asset classes and all of the strategies, everything in black. So everything performing well and delivering gains for the portfolio.
Is this customary for the investments to outshoot the outflow, or is this kind of unusual?
We can't rely on that every quarter, but we have seen that pretty persistently over the last several years, that the investment returns generated have been enough to offset the cash flowing out.
If that's true, then how do we get in such a financial bind that we're in?
Well, this is for the deferred compensation plan, sir.
Excuse me? Good question, just the wrong tree.
And so if you will now jump one page further ahead, you just want to, a quick check on performance. So if we focus on that last 10-year column on the right side of the page, and you were to go down each row, what this will tell you is that each of the investment options within the plan, by and large, is outperforming its benchmark after fees. So with a long-term perspective, performance remains very strong across the various options. And then the smaller numbers are the ranking within its peer group, so kind of the opportunity cost. And all of those are mostly above median and sometimes significantly better than that. So performance looks very strong. And the last area we like to focus on for the investment committee as fiduciaries is page 22, the cost associated with the plan. And the punchline is, if you go to the bottom of the table, the total row, you'll see a dollar-weighted fund net expense ratio of 25 basis points for the MDC, 0.25%. And that compares to something more aligned of 81 basis points for kind of the median or the average of the marketplace. So significant cost savings based on the scale and oversight of the MDC for the participants in the plan. So all told, things look very strong for the MDC from a performance and a cost perspective. Any questions before we look at ORP? Okay, we'll jump into the ORP book. And if you would just flip to page 2. For today, we only really have some summary comments on kind of the growth of the ORP over the last year. And all told, across the three platforms, the market value of assets is up over $340 million in the course of 1 year. So very, very strong growth from last September. And really what's driven that is most of the equity and the equity funds within the platforms. So for example, Corebridge, the mutual fund platform, has almost 52% of its assets in equity. Voya, almost 2/3 of its assets in equity, and TIA, just shy of 50%. So these are participant directed, people are using them as they see fit, but across the platforms, significant amount of equity, which when the markets have been doing as well as they have, has really helped bolster the values higher over the last year and the last couple of years. In terms of investment structure, each of these has their own flavor, but largely kind of mimics the investment structure of the MDC across the asset classes and the split of active and passive options offered. So we'll stop there for the ORP. And again, happy to take any questions the committee may have.
I guess since ORP is the primary retirement vehicle for these folks, we've got, it looks like that we've got about 20% still in the defined contribution, 20% are in stable value and.
Yeah, that's right. So most of the platforms are offset nicely like that. Risk orientation with the heavy equity, often the next biggest asset class is stable value. Right, so it's a nice diversifier and helps kind of balance out the risk.
Anybody have any questions?
All right, thank you, Mr. Chairman. The next item is for the hybrid defined contribution plan document. We would like to ask and recommend your final adoption on this document this time. This is the one, as you may recall, we recommended a slight pause at the last set of meetings and the committee and board deferred action till December. So we would like to recommend final adoption at this point. Regarding the last time we spoke about this, the reason associated with DFA and the statewide agencies and implementation, that issue we believe has been resolved. We were all able to work together and we think we've found a bridge solution for that. And so many thanks to all those involved internally and with the other agencies at DFA and with the Treasury. So that has been resolved and we can, in our opinion, and we think we can move forward. And no changes or no recommended changes to the initial adoption version of the plan document due to that. Separately, there are a few changes, as you see, that are in there. There are basically three areas of changes. You have a summary on top. Any of the changes are outlined in red. Two of them I would classify as more administrative kind of housekeeping changes. And then the last one, and the main one, the most notable one, has to do with the hardship provisions. The first area is essentially deleting, our first area of change is deleting a definition that's not used throughout the document. Another slight change is just correcting a duplication or a typo. And then again, the main changes deal with the hardship provisions, essentially changing from the terminology of unforeseeable emergency to hardship provisions. You can see those listed out toward the back. It starts around page 23 with most of the changes there in red. And those changes were recommended by Empower and drafted by Ice Miller. And of course, Ms. Lee is our point person who's very much involved as well. Ice Miller should be on the phone. So again, some recommendations recommended by Empower, drafted by Ice Miller, and we think they're more appropriate and understand them to be more appropriate for a 401A, which is the type that this plan will be. And if you read over them, they appear to be more flexible toward the participant, and it's adding in those safe harbor provisions. So I'll pause there. We recommend your approval, and we'd be glad to answer any questions.
Any questions?
Did you say that there were that the hardship provision was the largest change in here?
Yes, sir.
From last time?
Yes, sir.
Okay. And the other minor changes, were those the ones in red? Did you say that as well?
Yes, sir. They're in red as well.
Okay.
And they're just a little cleanup mainly.
Do we have a motion to adopt the final adoption for the proposed amendment?
So moved.
Second.
Motion and second. Any discussion? All in favor, by aye.
Aye.
Any opposed? Motion carries.
Thank you.
Any miscellaneous updates?
I have no other items.
With that, we will conclude the meeting of the Defined Contribution Committee.
Thank you.
Sir.
We're ready now to call the Investment Committee meeting to order. And the first item on the agenda, I'm going to turn it over to Charles to.
We're going to get straight into it real quick. This is going to be probably the busiest December investment committee meeting I've ever had in my 26 years here. So we have 8 different firms coming in to present to us today. It's going to be a very exciting day. Real quick, after several months of strong returns, global equities paused in November. The Standard & Poor's 500 managed a modest gain of about 0.2%, supported by solid corporate earnings, growing expectations for near-term rate cuts, and the resolution of the longest U.S. government shutdown on record. Yet concerns around elevated valuations and heavy AI-related spending weighed on sentiment. With growth stocks under pressure while value stocks outperformed. This divergence was evident globally as well, with developed markets showing resilience and emerging markets facing headwinds, particularly in regions tied closely to AI investments. In fixed income, U.S. markets were relatively subdued as investors digested delayed data releases due to the government shutdown. Treasury yields declined modestly, lifting the Bloomberg U.S. Treasury Index, while Japan stood out with a sharp rise in 10-year yields, reflecting expectations of higher rates amid currency and inflation pressures. On the 1st of December, the Federal Reserve ended quantitative tightening, with reserves once again below what is considered ample levels. Recent commentary from Chairman Powell and Governor Waller suggested that the Fed may soon restart quantitative easing. This potential policy pivot underscores the importance of monitoring liquid conditions and their implications for both markets and the broader economy. On the 10th of December, the Fed lowered its benchmark federal funds rate by a 0.25 percentage point, bringing the target range down to 3.5 to 3.75%. This marks the third consecutive rate cut since September of 2025, totaling 0.75 percentage points of easing for the calendar year. U.S. equities last week were under pressure, led by a sharp rotation out of tech and into value names. The NASDAQ fell 1.6% on Friday, extending a difficult week for tech, while the Standard & Poor's 500 slipped 1%. The Dow eased 0.5%, but managed a 1% gain for the week overall. Rising Treasury yields added to a cautious tone, with the 10-year moving above 4.18% and the 30-year above 4.85%. Investor concerns around AI-related valuations resurfaced after Broadcom's earnings, which, despite beating expectations, failed to provide clarity on AI profitability and sent shares down more than 10%. These developments are highlighting the ongoing scrutiny of tech margins and the market's preference for value in the current environment. For the month of November, the estimated PERS return for that month was 0.64%. So far for the month of December, the estimated month and fiscal year-to-date return as of yesterday was 0.4% and 7.34% respectively. So portfolio's doing very well, even with the volatility. With that, I am going to hand it over to John and let him cover performance and portfolio through October, I believe.
Thank you, Charles. Good morning, everyone. I'm going to be reading from the executive summary, and I'd ask you to turn to page 4 This is information as of October 31st. Last time we were with you, Alex covered the defined benefit through the third quarter. The information that we didn't have available at that point in time was the peer calculation in terms of how Mississippi PERS ranked relative to peers given the timing of the meeting. So I'm going to touch on that briefly and just do a little recap here. As of the third quarter, the quarterly return was a little over 5%, slightly trailing the benchmark, which was 5.4. This ranked in the top percentile, top 10% of your peers. So again, looking at a peer universe of 65 funds above 10 billion in assets, Mississippi PERS ranked in the 8th percentile, which is outperforming 92% of those funds. And again, strong returns across the board as we look as of September 30th. The 3-year return was an annualized 13.9%. Over the last 5 years, 9.8%. Over the last 10 years, 9.7%. And over the last 15 years, 9.3%. All of these returns are on the top quartile of your peer universe. So again, strong versus the peers over the last 5, 10, 15 years, outperforming its benchmark. So again, strong performance in various markets and certainly over the long term. So turning to the October update, we see that the funds stood at 38 billion at the end of October. And that was an increase of approximately 337 million from the end of the third quarter. And the positive investment return was 393 million, and the net outflow was 56 million. So this outflow is pretty much in keeping with the monthly outflow, with the exception of the fourth quarter. We see a big drawdown in the month of December. Asset allocation wasn't in line with expectations. Again, within 2% of targets. Real estate, slightly underweighted, fixed income, slightly underweighted, and domestic equity. International equity slightly exceeding the strategic allocation due largely to the strong performance that it's experienced year to date. The chart you see below, this diagram shows the short-term performance, and again, over the last month, fiscal year to date, and the last year. You see that over the last year, the fund has been up 15%, and the actuarial assumed rate of return that you have for this fund is 7%. So again, short-term performance over the last year, very strong. Longer-term performance also well in excess of 7%. So over the long term, the trailing 5-year return, 10.3%, and the 10-year return, 9.3%. Annualized return. So that's not a cumulative return, that is a per annum return. Any questions regarding the snapshot? Okay, let's turn to the markets. Charles touched on the October performance of the markets again. U.S. equities continue to advance. So we saw the Russell 3000, which is a reminder, Russell 3000 is the 3,000 largest U.S. equities traded in the market, was up 2.1%. Non-U.S. equities were up 1.8% in October, bringing the year-to-date return to 8.7%, which is slightly lagging the Russell, the U.S. equity return of 10.5%. U.S. investment grade, again, modestly positive at 0.6%, year-to-date 2.7%. And then real estate, again, we're seeing some bottoming out of the real estate markets where we're seeing that the appreciation, all but the office and retail, have generated appreciation in the value of assets. And again, they have an income component that also adds to that return. There's an empty box at the bottom as of 12/15, just to give you some sense of from the quarter to date, again, walking forward from 9/30, the Russell 3000, that's U.S. equities, were up 2.34%. Non-U.S. equities up 3.7%. And the fixed income, Bloomberg U.S. aggregate, that is your basket of investment grade fixed income securities, up 0.56. As you look at that chart, you can just see the burnt red bar at calendar year to date, showing that that is the MSCI ACWI US. Those are non-US equities up 28%, and US equities up for the same period year to date through October, up 16.8%. So again, these are real strong returns that we're seeing coming out of the equity markets. Have some people, there's a certain level of skittishness. Certainly the Magnificent Seven, AI, Tesla, these securities were really driving the market. We saw mixed results in November as some of these AI stocks sold off, NVIDIA, for instance. And, you know, the idea here is they're priced for perfection. Their performance has been so strong that there's a certain level of expectation that maybe they have gone too far ahead of the market. Again, the concentration is that they've performed so well that they're making up a bigger and bigger portion of these indexes. S&P 500, for instance, where they now represent, these Magnificent Seven represent more than 40% of the weighted portion of the S&P 500 index. Okay, so strong performance there. We'll certainly take it. Charles talked about the Fed, the cut in rates. We've had 3 consecutive cuts. December 10th, last week, there was the 25 basis point cut. There was some disagreement amongst the Fed members where we saw 9 were in favor of cutting at 25 basis points, 2 were in favor of no cut, and 1 was in favor of cutting it 50 basis points. So again, the idea here is that the Fed is challenged. They've got a 2-tier requirement. One is stability prices, and secondly is full employment. We've seen that the inflation number certainly has not gone up, ticked up modestly to 3% from 2.9 the prior month, but not to the degree that many were forecasting with respect to the impact of tariffs. So again, sticky, to be sure. Some of the employment data coming in, again, showing about a 4% unemployment. This is kind of ticked up from 3.9. This seems to be a greater focus of the Fed, thus justifying their cut in rates because they want to make sure that they're spurring growth on in the economy, but that's at the detriment potentially of inflation. So again, it's data dependency and waiting to get the information that they have. So it's not a certainty. They'll be cutting rates at the next meeting, but again, it's open for debate. Okay, any questions on that? Okay, turning to page 9. Again, this gives you just the snapshot of the asset classes, and you can see the value at $37.967 billion as of October end. And when you look at the target versus the actual, you see the percent difference, and certainly well contained. Again, international equity at 2.2% is overweight a little bit, but large distributions going to be taking place in December, an opportunity for rebalancing. Turning to page 10. On this slide, we read it from right to left. And you can see the September market value was $37.63 billion. Investment return was positive at $393 million. Net new investments, again, this is a cash outflow of about $56 million, coming to the ending balance of $37.96. Again, the cash flows with respect to the $55 million, this is really in line with what we saw last year at this point in time. So again, when we look at year-to-date withdrawals from the fund, very much in keeping, but again, we tend to see a big drawdown in the month of December. Turning to page 11, this shows you the monthly return, up about 1.05% versus 1.50 for the benchmark. And again, over the fiscal year to date, we're up 6.25%. So again, nice absolute returns as we look over the last year, up over 15%. So full participation in these very strong markets, longer term performance, 3 and 5 years at 13.2 and 10.3% annualized. So that is the highlights for the fund returns through October. I'll take a pause there and end if there's no questions on anything specifically, and I'll turn it back over to Charles.
Any questions? Okay, Charles?
All right, since there are no other questions, the next item on the agenda is the approval of the value-add real estate search criteria. I'm going to have Mr. Clark come up and present this too.
Good morning. This is the search criteria for a value-add real estate manager. Currently, we have 6 value-add managers. Of the 6 managers, we've participated in between 3 to 5 funds each over the last 15 to 20 years. Since 2022, interest rates and other factors have challenged real estate markets. As we've heard many times, times of such challenge give opportunity to evaluate. As a partner of mine on the private side, when I was there, used to say, he said, this is a time where you evaluate the cans and the can-nots, the haves and the have-nots. And that's what we're going to do, what we want to do. With the possibility that some of the current value-add managers may not come back with another fund, we want to take the opportunity to look at the other managers who fit the criteria of PERS Mississippi. And that's what the criteria is, what you have in front of you. Search factors, obviously being performance, sector exposure, fees, and fee structure is always important to us. Any questions?
So we are talking about 1 or 2 managers for this 200 million?
Correct.
We have a recommendation from our staff. I need a motion from the board for the approval of the value-added real estate search criteria.
I'll make the motion.
Motion? Second. And we have a second. Any further discussion or questions? All in favor say aye. Aye. Those opposed by the like sign. There being none, the search criteria is approved.
Thank you.
Mr. Chair, the next item on the agenda is to cover the AcquiX U.S. Manager search selection and the presentation. MFS is due to be in. They're running just a few moments late. So if you would prefer, we can move their presentation to after core infrastructure presentation, or we can start, the discussion on the AcquiX search.
How many minutes do you anticipate them being delayed getting here?
They sent me a message and said that they're actually on the way, but I can't give you a guaranteed time.
Okay. Then what I would suggest, if we go on to the core infrastructure managers, there's 4 of those.
That
So
is
that's gonna
correct.
put them, the MFS group, significantly later, and I don't know if they've got to turn around and catch a flight. Do you know how quickly their flight schedule would be?
I don't, but my assumption is that they'll be able to figure out a way to
We'll be able to.
get home.
Okay.
Yeah.
Then my suggestion is that we go to the core infrastructure managers, and let's go ahead with those and those presentations, and we'll get to the ex-US manager when they get here.
Thank you.
After these 4, we'll go to number 4 on the agenda and then come back to 3.
Thank you,
Is
sir.
that reasonable?
That is.
Okay.
Good to see you all again. I am extremely excited to be presenting this today. This is a endeavor that we have been working toward since Robert Clark was here and COVID was here. So that tells you how long this has been being worked on. This is a strategic expansion that we're ready to initiate. PERS introduced the infrastructure as a dedicated asset class following the 2001 asset liability study and the 2022 legislative expansion of the basket clause from 10 to 20%. We've been working on this, obviously, like I said, since Robert Clark was here. And I can't wait to call him after this meeting and tell him that his work has finally come to fruition. In June of '22, a 2% allocation representing approximately $750 million was approved to enhance portfolio diversification, inflation protection, and income stability. Our core managers, of the core managers, we evaluated 11 of them during this search. 4 of them we have here today that we would like to be considered to be hired. That's Blackstone Infrastructure Partners, Brookfield Supercore Partner Infrastructure Partners, EQT Active Core Infrastructure 2, and the JP Morgan Global Transportation Fund. I'll let each manager tell their story of strengths and strategy. I think you'll be impressed. These managers provide complementary sector coverage across transportation, utilities, energy, and digital infrastructure, with both the U.S. and international holdings, as well as legacy and new offerings to take advantage of the changing markets. PERS will commit $150 million to each manager, totaling $600 million, with the capital expected to be deployed over the next 2 to 6 quarters. And the reason 2 to 6 quarters is because as an open-end core fund, they can only call capital when deals and opportunities exist. This is not like a value fund where they have a time frame and they have to call it. This is not that. This is as opportunities come up and they see the opportunity that fits their strategy, they invest and call capital from their partners. Investments will be benchmarked against peer comparison index and reviewed regularly, just like the rest of alternative investments. Like real estate, we are building out the infrastructure portfolio with a heavy exposure to core, to open-ended funds for the premium cash yield, liquidity component, as well as the reduction of risk. That primary risk that we've seen here recently is inflation. These are regulated and contracted assets, meaning that they receive payment regardless. Just like your bills, if the lights go out, you still have an electric bill. Because of the regulated and contracted structure, open-ended core funds offer predictable cash yields, helping balance the portfolio's growth-oriented investments. While these 4 managers will account for $600 million of the approximate $750 million allocation, the remaining allocation will be filled by closed-end value-add opportunities that we expect to run a search for later in 2026. Are there any questions? We will start.
Let me
Sure.
ask a question. We will hear all of the presentations and then vote after the presentations. Is that the?
Yes, sir.
Okay. We will hear the presentations and vote afterward. One question that I do have and would want to clarify, the basket, even though you have stated these are regulated, anytime in the past that we have interviewed and recommended money managers, we have made it perfectly clear that we only want them to consider the returns that the companies they are investing our money in be considered. We are not in the business of considering any environmental, social, or governance issues. And all of that has continued with these 4 new things as we've done clearly. Now, that's not to say if there's a tool involved in some of that and it impacts returns in a positive way, that's fine. Don't have, but, you know, the, whatever it is, the prevailing sense or social or whoever's in the White House, you know, basically, we don't want that impact and we want returns is what we're for. Does that make sense? I just wanted to clarify that for our board and the audience as well. Okay, go ahead.
I don't think that that'll be an issue, and I welcome you to ask that to each one of them. Blackstone will be first. This is not BlackRock, but Blackstone, one of the largest infrastructure managers in the world. And we'll go in alphabetical order with Brookfield, EQT, and JP Morgan Transportation after that. And we will bring Blackstone in if there's no other questions.
Are we ready? Okay, we'll go ahead and hear the Blackstone then.
Yes, sir.
Get them forward. We do have copies of their presentations in your materials here. Blake, if you'll introduce your colleague, we'll turn it over to you for the next 15 or 20 minutes for this presentation.
Well, great. Well, thank you all so much for having us here today. For those of you I haven't met, which is most of you here, my name is Sam Mercer, and I'm on the investor relations team at Blackstone. And I just want to start by saying, on behalf of Blackstone, we're so honored to be here today to present to you all on a potential partnership with Blackstone Infrastructure. Delivering strong returns for our limited partners is our North Star at Blackstone. And we are so excited at the opportunity to be able to potentially do that for the Public Employees Retirement System of Mississippi. Now, I want to start by saying thank you to Jason and the team for all your hard work. It's been such a pleasure getting to know you over the last few years. And also a thank you to the Callan team, Lauren and Johnny, for all of your support throughout this process as well. Now, I'd like to introduce my colleague here, Greg Blank. Greg is a senior managing director with Blackstone Infrastructure Partners. Greg has been with Blackstone for 16 years, working across both private equity as well as infrastructure, where he was a founding partner on the team. Greg oversees all of our digital infrastructure investments. This includes marquee transactions like QTS, AirTrunk, as well as our partnership with Digital Realty. Now, we have a presentation we'll go through here today and leave some time for questions. And with that, I'll pass it to Greg.
We do have your presentation in front of us, so if you'll just page number us through as you go, we'll be pleased. Thank you.
Perfect. Thank you so much for having us. If we flip to page 3, it's a thick deck. I promise I will not cover all those in 15 or 20 minutes. Just a little bit of a snapshot on the Blackstone infrastructure platform. Today, we're about $69 billion of assets. We've invested close to $12 billion this year. I think important to highlight, almost 40% of that is money that we invest back into our portfolio companies, as that's really, for us, important as we drive growth in our businesses. As you think about where we sit, we're core plus focused. We tend to focus on businesses that are regulated or contracted, so looking for long-term contracted cash flows, lower risk businesses in high growth sectors. Our focus would tend to be North America, so sort of 3/4 of our assets would be in North America, and we're an open-ended fund, which is, we think, sort of very important for investing in these types of long duration assets. On the team side, approximately 100 people, split primarily US, 15, 20 in London, and senior team's been in the industry for 20 plus years. You flip to the next page, page 4. I think as we think about how we invest in sort of some of the core tenets of our investment strategy, this page really lays out the 4 of them. I think the first is, at Blackstone, we're thematic investors. So everything we invest in is behind a long-term mega trend. If you look at the subsectors in which we invest, which I'll talk about later, they grow at about 12%, so 5 to 6 times the rate of overall US GDP. And for us as a long-term investor, finding sectors where you have tailwinds, where there's long-term sectoral tailwinds is very, very important. The second is scale. We tend to write large checks. We tend to buy industry-leading businesses. That's a very deliberate strategy. Our goal is invest in the industry leader and then continue investing in those businesses over time. And I think as we look at the infrastructure space, the difference between owning Coke or Pepsi, or pick your analogy, it's really, really important. So our strategy is very focused on trying to buy those industry leaders, which tend to be those bigger businesses that are better run. Third piece, This open-ended capital, this perpetual capital that we have, it's very differentiated. And if you look at our portfolio, I'll cover it in a few pages, 70% of our investments were done in partnerships with families or founders. And what you find is in a lot of these infrastructure businesses, they tend to have been owned by families for decades, or they're founder run, and they're looking for somebody who can be their long-term partner for 10 plus years. And that's why this open-ended capital is very, very differentiated, and it's sort of been on one of our calling cards in the types of deals we've done. And then the last, value creation. At our heart at Blackstone, we are a private equity firm. You know, we're always trying to think about how we drive value as investors. So every time we make an investment, there's always a value creation plan. We're trying to figure out how do we grow the business faster? How do we generate better returns for our investors? If you flip to the next page, page 5, please. I think on just sort of as we think about the infrastructure asset class and the area in which we're investing, I think it's really important. This is defensively positioned across cycles. Our goal is to deliver strong risk-adjusted returns in good times and bad times. And how do we do that? We're diversified across sectors. So we invest in 3 main sectors: energy infrastructure, digital infrastructure, which would be data centers and cell towers, and transportation infrastructure. And so our goal is try to be diversified across sectors. If you look at infrastructure in general, it has a beta of 0.54. So effectively, it's 45% less volatile than the market, despite growing 5 times as fast. So that's really the focus here, is identify those subsectors, businesses that have low volatility, and give diversification to investors' portfolios. At the same time, they generate a very consistent yield. We've paid a 4% yield across our businesses, and that just really goes back to these businesses have long-term contracted cash flows. They have stability of income, and they're in areas that are growing very, very fast. If you flip to page 6, please. This is the snapshot of our portfolio today. Again, as an open-ended fund, when an investor invests effectively, they would own a piece of every one of these companies. And so this is organized by sector. So transportation across the top, energy across the middle, and digital infrastructure across the bottom. If you think about what do we own in the transportation space? It's ports, it's private aviation, it's airports. We own the largest ports business in North America. We own the Rome Airport, for example. We own the concession on the Channel in the UK. So some of these irreplicable infrastructure assets. On the energy side, if you think about this growth in electricity demand that we're seeing in the country, this is going to require a significant investment across all elements of the energy ecosystem. And for us, we can do this in a regulated or contracted way. And so you'll see that what's in our portfolio today. We own Tallgrass, midstream pipeline, so natural gas pipeline, longest pipeline across the country. We own Cheniere, which is natural gas export, big facility in Sabine Pass, Louisiana. We own several utilities. And so for us, we're trying to invest every way across that value chain, but doing it in a regulated or contracted way. And then digital infrastructure, which is the area I've historically spent time. It's data centers, it's cell towers, QTS, which is our leading data center business we acquired about 4 years ago for $10 billion. That business today has now grown, more than 10 times. It's now the biggest data center business in the world. And so I think we have a unique collection of these assets across our portfolio. Flipping to page 7 quickly, we've touched on the team. I think 2 important points to highlight. First, on the investment committee for this business, it's really the senior leaders of Blackstone, Steve Schwarzman, John Gray, as well as the leaders of our private equity, our real estate, our energy businesses. So the senior leaders across the firm are our committee, and then the investment team below, which is close to 100 of us, as well as our portfolio operations team. And then maybe if we flipped, just in the interest of time, flip to page 10, please. I think as you I referenced this up front, but as you think about where we play in the sector, we're firmly core plus focused. So that means we're investing in businesses. They are hard assets. They're concessions. They're either regulated or contracted. We're not investing capital before we have signed contracts. So trying to invest capital in a very, very de-risked way. I think as you think about what we give, what do we provide partners? How do we win investments? We have long-term capital. That's a huge advantage. If you look across our portfolio of companies on the page with all the logos, almost 2/3 of those, we're either in a partnership with a family or a founder of a business. Most of our CEOs are founders. And what do they like about partnering with us? We can be their long-term partner. We provide them significant capital. We can help them drive value in their businesses, help them expand, help them finance their businesses differently, help them grow their businesses faster, which is something that's very, very valuable to them as a partner. If you flip maybe to page 12, I sort of referenced this earlier, but on the themes, I think it's really important as you think about our three sectors, which are energy, transportation, and digital, they are really underpinned by a key long-term megatrend. First, on the energy side, so what's the big megatrend that we're focused on? If you look at U.S. electricity demand, that has effectively been flat for the past 30 years. And we're really now hitting this inflection point where you've gone from an industry that maybe grew at 0.3 or 0.4% a year for the last 20 or 30 years. It's now projected to grow 40 to 50% over the next decade. And so if you think about the U.S. electrical grid, it's old, it's underinvested, it was set up for no growth, and now it's going to have this profound growth across the country. And so if you think about all the investment that's going to be required, this is probably the biggest mega trend that we see. It's going to be trillions of dollars of capital. It's everything from pipelines to power plants to transmission lines to utility upgrades to exporting gas. And for us, those are all different ways we can invest in this trend of growing electricity demand, but doing it in a regulated or contracted way. So this is probably the area in our portfolio where I think we see the most opportunity here over the next 3 to 5 years, just given this growth in demand that we're now all seeing across the country. Second bucket on the transportation side, this is really two trends. First is, if you think about the movement of, it's really the movement of people and goods. Think about everything that's required to get an Amazon package to your house, right? It takes ports, it takes logistics networks. More and more goods are being shipped. That is growing at 2 times GDP. We like that trend. We're investing in ports. We're investing in logistics behind those. That's a trend we see as long-term and sustainable. At the same time, people are traveling more, spending money on experiences. So we're also investing in that, aviation, airports. We own probably almost all the toll roads in Italy, a lot of the toll roads across Europe. So trying to own those as a way to sort of play that long-term trend, which is growing well in excess of GDP. And then finally, on the digital infrastructure side, this is now the topic that you can't turn on TV without somebody talking about this, but this is probably the mega trend of all mega trends in terms of, if you just think about the digitization of our lives and all the different ways that we interact with digital infrastructure, which is just the fancy word for cell towers, data centers, and fiber networks. Every time you touch your cell phone and you touch an application, the software that runs that sitting in some data center 2,000 miles away. And more of this is happening, and there's a huge wave of spending to really continue to digitize and change the way that we use and consume data. The nice part for us is we can invest in this in a very low-risk way, long-term contracts with some of the best and most well-capitalized companies in the world. Just in the interest of time, maybe just flipping to page 15 quickly. I think as you look at the overall infrastructure sector, I think what gets us particularly excited about this as a long-term investor is just the need that there is in the world. There's probably over 100, you think about somebody's forecast, over $100 trillion demand globally over the next 15, 20 years. Most of this is coming from private sources. The vast majority of this is going to come in our 3 sectors of energy, digital, and transportation. And so it's an area that we think there's tremendous opportunities and tremendous tailwinds. And for us, when there's this huge demand and private capital is going to be the solution, you can earn very good risk-adjusted returns investing behind it. And then maybe just to wrap up here, maybe we go to page 20 and 21. Start on page 20. As we think about the areas that we'll be focused on here over the next 5 to 10 years, I'd say our 4 biggest areas of focus would be U.S. utilities, digital infrastructure, transportation, and pipelines. Maybe I'll just spend a few seconds on each of these. On U.S. utilities, this is an area we've been very active in. We own 3 utility investments today. If you think about this growth in electricity demand, one of the lowest risk ways to invest behind that is investing in utilities. This is everything from generation of power, transmission lines, all the electricity lines into your home, into a business. Every time you invest capital in utility, it earns a regulated rate of return. And so for us, this is something we this is something we're very focused on. We announced an acquisition earlier this year of a business called TXNM, which provides electricity. It's a creative name for a business that operates in Texas and New Mexico. And that's just another one. It's our third utility investment. It's an area that we think there's a tremendous amount of supply. It's a regulated or contracted model, and we'll continue to be active in that space. On the digital infrastructure side, again, data centers, cell towers primarily, this is a global trend. As you can see in all the stories that we're seeing every day, the largest technology companies are continuing to invest a significant amount of capital in this sector. 5 or 6 companies are probably going to invest almost $400 billion this year alone in data centers to power their next generation of software and their artificial intelligence software applications. And so what are we doing? We're signing 10 or 20-year leases with them to rent them effectively the data center, which stores their computers, their servers, and their chips. So that's an area of fast growth, but we are doing it again in a low-risk way. On the transportation side, continue to see good demand on the leisure travel side and also the sort of the shipping and transport side. We have significant opportunities to continue investing capital in our businesses. So I think it's an area that we will continue to be focused on. And the last is pipelines. If you think about in the last decade in the U.S., we've effectively built no new pipelines, but the demand for natural gas has gone up 30 to 40%. So there's this demand-supply mismatch that I think is only going to get worse over time because natural gas is going to be one of the most important components providing this power to bridge this electricity need that the country has. And so this is an area, we own one big investment in it today. We will continue to be active in it, and we think there will be very good risk-adjusted returns.
Question.
Please.
Do you think the politicization of the issue of dealing with pipelines on a national level, the unknown factor of all that will affect you in any way?
I think it's a great question. I would say it's interesting. Probably 5 years ago, there was probably more politicization around this. I think as there's been a recognition that electricity demand is growing and there will be a lot of constraints across the value chain, it's actually become a more bipartisan issue than it has historically. And I think particularly on the digital infrastructure, so data centers and the broadly defined energy infrastructure, it's one of the few areas that you've seen bipartisan agreement that, we need power. It's going to provide our data centers, it's going to provide our lives. And to do that, you need all parts of the value chain, and pipelines are an important component of that.
Thank you.
Following up on that pipeline issue, I've lost contact with the news of the Canadian Southern Pipeline. What is your understanding of where that stands and the impact that it will make? And are you investing in that? I mean, if it's happening.
Yeah, so we're not investing in that today. I think that one has been, there has been a long regulatory process around that. And I think in general, one of the challenges of some of these energy assets is they take a long time to develop, right? There's a lot of approvals. So that one I think has not yet received regulatory approval. I think if you think about that, Canada actually has a lot of natural gas. They can't get it down to the U.S. where there's a bigger market. So at some point, maybe that changes, and we would evaluate it at the time, but not something that we're spending time on today.
Thank you.
We had 2 to go across our land, and it sure is easy money.
Your personal land?
Inherited land.
Yeah, man's getting rich over here, got a pipeline right there.
Keep investing.
Yes. And maybe just on the last page, page 21, this sort of just breaks down our new opportunities on the right side. If you look at this is sort of the near-term pipeline. It's across the sectors we've highlighted. We're also looking at a waste opportunity. Again, that's an essential services business. And I think the other important point is when we buy these investments, it's not just invest in the company once, it's continuing to invest behind them. So in most years, 40 to 50% of the capital we invest tends to be back into our portfolio companies. And we really like that because that's funding growth. That's building new pipelines, expanding power plants, expanding our ports, building new data centers. And that's really the power of buying these industry-leading businesses. So I know we're a bit pressed for time, so I'm happy to pause, answer any questions.
Any questions? Yes, go ahead.
You may have mentioned it, sorry, but nuclear utilities, any expansion, building of that planned from Blackstone?
So today we don't have any investments in nuclear. I think as you think about nuclear, if you from a sort of on a piece of paper, it makes a ton of sense. I think the challenge historically has been both economics and regulatory pieces, just in terms of it's not economic today relative to building a natural gas plant. The second piece is the regulatory process is very, very long. So I think it will certainly be part of the solution that we see to this electricity demand. But it's, for us, it's probably further out. It's probably closer to 2040 than 2030. So today, it's not something we spent a lot of time on.
So natural gas costs are keeping it.
Yeah, natural gas is if you think about you need power to run 24/7 to keep all the lights on, natural gas would be the most efficient power to, the US is blessed with lots of natural gas, generally good pipeline infrastructure. And so natural gas will be, I think, the key part of that bridge for us for the next couple of decades.
What is y'all's pivot strategy when a different administration comes in one day? I mean, whether it's 3 years from now, 7 years from now, whenever it is. What's y'all's pivot strategy on energy? I mean, because I'm listening to all the things y'all invest in, and they're very pro-Republican kind of ideas. I mean, with a different administration, I know you said the data centers and everybody kind of agrees that we need energy to power these data centers, and the appetite for energy is very strong, especially, I mean, we see it here in Mississippi all the time with everything that's happening. But with new administration comes new environmental concerns and other policies that they have to answer to their constituents for. What's y'all's kind of pivot strategy with that?
I think the first principles are always the product, whatever projects we're doing or our companies, the economics have to work without any government subsidies or impact. And so as a long-term investor, right, if we're thinking about a 20-year time horizon, there will be 5 different presidential elections between now and then, and who knows what will happen, but a lot changes. And so that's why we tend to focus on the private sector. We tend to focus on long-term contracts in the private sector and basically de-risking those investments before we invest dollars, such that when we sign we already have the signed contract before we go build something as a de-risking strategy to make sure that, whatever policies change, you've protected yourself in that way.
All right, great, thank you.
Other questions from board members? Yes, go ahead.
While the fund is global, you mentioned Cheniere in Louisiana. Mississippi economic development is growing leaps and bounds. Hotbed of energy, digital, pipelines, transportation, all of them. Can you give an example or give any examples of opportunities in the Southeast, specifically Mississippi, Louisiana? And will this growth continue for those opportunities in the Southeast?
I think the Southeast is particularly well positioned. If you think about low cost of power, good infrastructure, good access to gas, particularly Louisiana has big reserves. So we've looked at, in the region, we've looked at data centers, we've looked at different power projects. We don't have anything of scale yet in Mississippi, but I think this region, just given the trends and sort of the access to key inputs, I think we'll be particularly well positioned. And you're seeing a big data center project being built in Louisiana right now. Georgia's now the second biggest data center market in the world. And so I think it's only a matter of time, just given the energy resources here, until that becomes a big part of it. Our business has looked at a couple things. We haven't gotten there yet on those, but I think over time we probably will.
How does your company interact or access part of the Tennessee Valley Authority? How does that work with you all?
So typically when we're procuring, the Tennessee Valley Authority, right, they have their power plants and they sort of supply parts of the region. We typically, when we're building a project, if it's a data center, for example, we need a significant amount of power. We would go to the local utility who basically has effectively has the transmission lines in that region and negotiate a contract. Sometimes they generate the power themselves. Sometimes they buy it from the TVA or other parts of the region. And so we're sort of one step removed from that. But again, they're a large producer of power. That's a very valuable asset. And so I think over time, they will have probably a bigger seat at the table.
Other questions? Anything from Callan or any questions there? No, sir. Then, Charles, I believe you have any further questions for your group? Then we appreciate y'all coming and sharing with us today. Interesting presentation, and we'll be back with you all shortly. Okay?
Thank you so much for your time.
Y'all have a great afternoon. Guys, Excuse me, Master of Science from Tulane. Whoops, I didn't mean to be talking about you, I apologize. Welcome to the Investment Committee of PERS. We're glad that you all are here with us today. Chase and Natalie, if you could limit your remarks to about 20 minutes, and just short of that to allow us for some questions. But other than that, we have your materials in front of us. If you'll just tell us the page number where you are, and we'll follow along.
First and foremost, thank you so much for having us. We're honored to be here, and we're excited about the potential partnership. I think we've been talking to Jason for 2 to 3 years now about infrastructure broadly, and excited to see this day kind of come. My name's Chase Haymond. I oversee...
That microphone right there, please.
Yep. Chase Haymond, I oversee our relationships across the Southeast, based in Austin, Texas. And joining me to my left is Natalie Haddad, who's a managing partner and co-head of our SuperCore strategy. So the agenda today is a broad overview of that SuperCore strategy. And with that, I'll hand it over to Natalie.
Great, thank you. And is this okay? Yes, okay, great. Very nice to meet you all. Just by way of background, my name is Natalie Haddad, and I've been with Brookfield for about 13 years in the infrastructure investments team, in a variety of roles over the years. Most recently, when we launched our SuperCore strategy in 2019, I was one of the founding members. I still am fully dedicated to the fund, and today I'm the co-head, which means I have oversight over capital deployment, capital allocation, and just general asset management on behalf of the fund. So with that, and before jumping into the overview of SuperCore, maybe just quickly touching on Brookfield's presence in Mississippi. We made our first investment in the state in 2018. And since then, we have deployed over $1 billion of capital in the state, including critical infrastructure assets. This figure, unfortunately, doesn't include some recent investments that we have made, mainly in Colonial Pipeline, which is one of the largest refined products pipeline system in the U.S. that runs from Houston through Mississippi, all the way to New Jersey, transporting gasoline, diesel, jet fuel, et cetera, but most importantly has delivery and storage points here in the state of Mississippi. Another example is a data center that we're building in the state for Meta. That project will require about $10 billion in investment. And lastly, we have multiple railroad short lines in the state, primarily serving the steel industry. Our main customer is Steel Dynamic. So these investments are part of our infrastructure platform. They weren't made through SuperCore. We're actively looking for investments across the U.S. So, in the foreseeable future, we may be looking to add more Mississippi exposure specifically in the SuperCore portfolio. So with that, maybe jumping to page 4, the overview of the strategy. So Brookfield has been investing in infrastructure for over 100 years. We actually started as infrastructure owners and operators. When you look at our origin story, we were not a private equity firm, based in New York that one day said, let's invest in infrastructure. We actually started investing in infrastructure on our balance sheet, and we built a light train system and an electricity distribution utility in Brazil. So as a Canadian company, raised capital and started investing in infrastructure globally. Our first project was in Brazil. With that experience, 7 years ago, we launched BSIP as an open-end perpetual infrastructure fund. And that was mainly driven by 2 things. One was the demand by our existing investors, looking for a fixed income substitute, essentially a perpetual inflation-linked bond. And And the second driver was there were a significant number of opportunities in the market for stabilized, de-risked, mature cash yielding assets that within our Brookfield platform, we didn't have the right vehicle to pursue. So those two things came together and we launched Supercore. Today, the fund has a net asset value of about 15 billion. We have deployed significant co-investment alongside the fund. The total size of the program is actually closer to 25 billion when including that co-invest capital. The portfolio includes 29 operating businesses across multiple sectors, 7 different sectors, 12 different countries. And most importantly, 99% of the cash flows, so virtually all of the cash flows that are generated by the investments that we've made in the portfolio are either regulated or take or pay contracted. And what this means is that we generate these cash flows, we earn the revenues irrespective of utilization, irrespective of economic activity, irrespective of GDP fluctuations. They are insulated from GDP volatility, given that on the regulated side, we earn a fixed return on capital that has been invested. And on the contracted side, the take or pay provision means that we get paid irrespective of whether customers use the assets or not, or whether they use it at 100% or 50% or 0%, their revenues are the same. And we've been intentional in executing that as our investment strategy. That's how we devised the perimeter that Supercore is meant to invest in. And in terms of performance, we are targeting and have delivered a 10% gross return since inception, 8.5% net, and with a meaningful component of asset yield. About half of the return comes from initial yield generated by the investments. So moving on to page 5, this is perhaps one of the key takeaways that I'd like to leave you with today. So the intentional and disciplined execution of our low-risk investment strategy is best seen in how performance has been delivered through market cycles. So since inception, BSIP has been able to not only outperform comparable indices, but it has done so with very limited to low volatility. And it has been tested through pandemic, rising inflation, high interest rate environment, geopolitical disruption, tariffs, etc. And this is a result of the very strict definition of what constitutes core infrastructure for us, and that is, the regulated frameworks, the take-or-pay contracts, prudent approach to capital structure. We only invest in OECD countries and thus are not investing in emerging markets. So that has been seen through the performance. So in the next couple of minutes, I'd like to maybe touch on 3 key things. One is a little more information on the Brookfield platform. An overview of the strategy. How is it that we define core, and what is it that we're looking to invest in, and what does the portfolio look like today at a very high level. So moving on to the infrastructure platform on page 7. So I've mentioned that Brookfield has been investing in infrastructure for over 100 years, and we are doing so with boots in the ground across the major geographies where we operate. So this is North America, Western Europe, and Asia Pacific, predominantly Australia. These are the 3 target geographies for BSIP and where Brookfield has meaningful presence. We have 470 individuals in our infrastructure platform, and the scale, the size of this platform allows us to have breadth and depth in what we're able to, in the transactions that we're able to pursue. Most of these are proprietary as opposed to auction. So we're able to leverage the scale of the platform to develop and maintain relationships with asset owners. And also, we rely on the operating expertise that we have developed over the years as owners and operators to implement a hands-on asset management approach, which means that we're not only looking to realize returns from buying low and selling high or from financial optimizations. We are focused on the operations. We look to realize value by maximizing revenues that are generated, by cost efficiencies, by optimizing the capital structure, by executing capital projects on time and on budget. And how do we do that? If we turn to page 8, we do that through our one team approach. So we have a single infrastructure team, and BSIP benefits from this one team approach, where we have an investment committee that is comprised of the most senior members of the firm that have been with Brookfield on average 20 years, and a dedicated BSIP leadership team. These are 5 individuals that are dedicated to the BSIP strategy and that are responsible and oversee the execution of the strategy and execution against the business plans. And we rely on the global investment and portfolio management teams that in addition to the BSIP leadership team is sourcing transaction, undertaking due diligence, and executing the asset management plans. So when you look at the composition of this team, we have about 200 investment professionals. We have about 300 operating professionals and subject matter experts. And this is a key differentiator when you look at the infrastructure managers in the market, given that this operating expertise sits within Brookfield. So these individuals are on Brookfield payroll. They are aligned with the performance of the investments and the funds. And these are not external advisors or third-party advisors. These are Brookfield employees, and they have experience running businesses. They have negotiated contracts. They have been CEOs of utilities, whether our utilities or external utilities, and we bring them on board. And they are assigned across the various portfolio investments. So an operating partner, that's how we call them, they would be assigned to, say, one of our BSIP regulated utilities, and they would be responsible to work with the management team of that business in order to execute the plan that we underwrite when we make the investment. So that's on the team. If we go to page 10, I'll very quickly touch on our definition of core. So what is it that we mean when we say we're investing in low-risk infrastructure? That is a subset of the infrastructure market that is comprised of essential infrastructure, so infrastructure that provides absolutely essential, irreplaceable services, such as electric transmission or electric distribution, or telecom tower service, that are located in the most developed OECD jurisdictions. We only invest in mature operating assets, so assets that are already cash generative, that are not under construction, we're not running development, greenfield, or construction risk. Investments that have high cash flow visibility through regulatory frameworks or contracts, and that have inflation protection. And this is very important. One of the key differentiators is that all of our investments have some form of inflation protection, whether it is direct CPI linkage, cost pass-throughs, or regulated pricing, and thus are able to not only pass through the impact of higher inflation, but higher inflation accretes to the value of these investments. And on the assets that are contracted, we have highly creditworthy counterparties on the other end. So these are investment-grade counterparties that are financially robust and that have very little to no risk of payment default. Lastly, our approach to financing is also unique in the sense that we're targeting investment-grade credit metrics. It's a prudent approach to financing, commensurate with the low-risk nature of the strategy. Not only do we size debt to investment grade, but the debt is fixed rate, which means that the interest rate is fixed for the duration of the financing, and long-dated maturities, which means that we mitigate interest rate and refinancing risk by putting in place long-dated debt facilities. So all in all, through this very specific set of criteria, BSIP offers protections against macroeconomic fluctuations and that have resulted in very predictable cash flows and consistent returns over time. So maybe lastly, I'll touch on the portfolio on page 12. So the portfolio today is comprised of 29 businesses. No single business represents more than 13% of the portfolio. Spread across 7 different sectors, no single sector represents more than 30%. And in terms of geography, the businesses span 12 different countries. The majority of the portfolio is located in the US. And we expect that going forward, when we look at the pipeline of opportunities, the exposure to the US will continue to be the most dominant. And maybe finally, on page 13, so just to underscore the high quality and the criticality and essentiality of the assets in the portfolio, when you look at a snapshot, there's over 50 billion of regulated asset base in the portfolio across the regulated utilities, again, spanning electric transmission, electric distribution, gas distribution businesses, with over 140,000 miles of transmission and distribution networks, over 15 gigawatts of generation capacity, over 10,000 revenue generating units. And this is relevant because the single asset exposure is mitigated by having breadth in the portfolio and serving over 175 million users. So to close it out on page 14, the experience that the team has in the investing and realizing value in infrastructure assets, the disciplined execution of the low risk strategy comes through in the returns. On page 14, we see that the gross time-weighted return has been 10% since inception and in the last 12 months. And it's been consistently in that level. So all investments are performing in line with targets. This is not, while the headline number is in line with targets, when you look behind the scenes, you're not going to find one investment that is underperforming and another one that is outperforming, bringing their average up. It's all very consistent. There are no outliers in the portfolio. On the yield side, yield has been also consistent over time. About half of the return coming from yield that is generated by the investments, in the 5 to 5.5% neighborhood at the asset level, and 4 to 4.5% net yield at the fund level. So this stability again reflects the differentiated low risk strategy, the discipline which we've deployed the capital, and the active asset management based on the experience of the team. So with that's the extent of our prepared remarks, and happy to take any questions.
You mentioned something also about pipelines and your investment there, and we had a good discussion earlier this morning on that. Treasurer McRae asked a very pertinent question as it related to the politicalization of that issue. Do you mind asking the question again?
Sure. Thanks for putting me on the spot there. Yeah, a second ago, I asked the people who were in here doing the presentation, was that, you know, with the climate today, what is y'all's pivot strategy when the political climate changes to not a conservative climate, but more of a different climate, and changes their energy ideas and regulations? I mean, what is y'all's pivot strategy for the future? I mean, I'm never concerned about what's happening today. I'm always looking about what's happening down the road. And obviously, with the current administration, has 3 years left in it, there will be somebody different, whether it's Republican or Democrat, and they'll have their own ideas on environmental policies and what they view as important to energy. I know that electricity and everything, it will be, both sides have an appetite for it, but beyond that, what is y'all's pivot strategy in terms of energy in the United States, and how do y'all move about that and manage that?
Sure, that's a very good question. And, you know, and I know I've said this numerous times, we've been investing in infrastructure for a very long time. So there are lessons learned throughout the multiple decades and multiple cycles. And perhaps the single most important lesson that we've learned is that we need to invest in assets that are durable, irrespective of political climate. So the fact that we're investing in essential infrastructure that either has no alternative or it's the least cost alternative, that is the biggest mitigant to changes in the political stance towards a particular industry or a particular technology. So that at a very high level. Then, you know, so to answer your question very directly, how do we mitigate that risk, or how do we address that risk is going in. That means before we invest, we diligence, you know, are we investing in durable cash flows that are not subject, that are subject to, you know, subsidies? That's typically not a good sign. We invest in businesses that can stand on their own, irrespective of, you know, whether there are subsidies or not. Two is, we are, through this strategy, we don't underwrite, or we don't expect growth to drive returns. So we're investing in what's in place, what's in the ground. And as long as we continue to maintain and replace what's in the ground that is expected to remain used and useful over the long term, we make our 10% return. Anything over and above that would be speculative, and it's upside. And we'll take advantage of the current administration if it's supportive of that.
You're not gonna turn it down if it gets to 11%.
But we focus on the durability of what's in place.
Okay, appreciate it. Thank you.
Other questions? No other questions. We thank y'all for coming and making a presentation. It was informative, and we'll certainly consider all of this as we go forward. So appreciate y'all coming down and taking the time to share with us.
Thank you so much.
Rick, she wants to stay over to see the Tulane Ole Miss game.
Saturday, Ole Miss and Tulane.
Oh. I would love to. I am needed back home, though.
I'm glad you left him at home.
Exactly. Great to be with all you this morning.
Yeah, well, we'll appreciate, you coming down and representing, the EQT Active Core Group, and, so we're gonna turn it over to you for about 15 minutes, allow us to ask some questions at the end if we have any. So I'm gonna turn it over to you.
Thank you so much. Well, Alex Greenbaum, I've been investing in sort of the core infrastructure space for over 20 years now. My entire career basically focused on that. First as an investment banker many years ago, and then at GIC, the Singapore Sovereign Wealth Fund, where we did a really interesting portfolio. We invested in funds ourselves, did co-investing, did direct investing, also looked at listed equities in infrastructure and private credit in infrastructure. So it was a really unique experience and a really unique way of looking at the world. I came to EQT about 5 years ago to start our active core infrastructure fund because what I really saw was something missing from the market, which was active ownership in the core infrastructure space. We'll get into this in a little bit more detail, but I think that's really there's a reason it's in the name of our fund, which is our approach is buy great core infrastructure assets, but not just sit on your hands, actually look to improve them and grow those yields and compound returns for long duration. And so that's really the sort of fundamental ethos of our fund. Flipping to page number 3, if you have the materials, the slide titled Introduction to EQT. EQT is a European fund that was started about 30 years ago by a family in Europe called the Wallenberg family. Their sort of approach was almost a really industrial approach to investing, that rather than just being financial investors, what they could bring was their relationships with industrial operators of assets. So it's a mindset around we invest in companies that we believe we can improve operationally, and that's the value that we bring to those situations. The other sort of founding ethos of the firm was a locals with locals approach. So not flying people in and out of different markets, but actually having people locally in markets who understand the businesses. Because infrastructure especially can be a very local business, local regulation, local stakeholders. And so our approach to that has always, kind of been this locals with locals mindset. Moving to the next slide. This kind of gives a little bit of a landscape of the different funds that we have at EQT in the infrastructure business. So we have a transition infrastructure fund that's really focused on scaling up newer technologies, higher risk, higher return. In the middle, we have our value add infrastructure fund, which is looking at more transformational changes to businesses. So businesses where there's something really big going on, usually quite a bit of construction and development or a transformation of the business. And then the active core infrastructure fund, which is where I sit and what I oversee, and that is the business that really is focused on optimizing businesses. So buying great, stable, cash-yielding businesses, but improving and optimizing them. We do this with a team of 140 investment professionals around the world, across 13 offices. And the way we do it that is kind of unique is, as I mentioned, this industrial mindset. We have 600 plus industrial advisors with different skill sets and backgrounds. We'll talk about this a little bit more, but those industrial advisors work with us from start to finish on transactions and then sit on the board with us when we make investments to help us create value. And it really is something quite unique to EQT. Page 5, just a little bit of a high-level glance. We really believe in what we see right now in the infrastructure market, and specifically the core infrastructure market. It is a unique time insofar as the amount of capital that's needed for investment in power, in digital infrastructure, and also in reindustrializing our transportation and logistics networks. And so that kind of creates the opportunity that we see in front of us. If I think about kind of why to invest in this space and why now, I think page 6 is a good example of this. We see these tailwinds now in the market where the need for capital is so great and the supply of it is there but is growing. And so that creates a supply-demand imbalance and a tremendous opportunity to invest. In core infrastructure specifically, you've probably heard from my competitors, my peers, the downside protection is truly unique. We're buying businesses that have really strong fundamental, either contractual or regulated moats around them. And that strong contractual or regulated moat gives us stable income, predictable earnings, so that when everything else goes wrong in the world, these should be the parts of the portfolio that really survive and actually thrive when there's dislocation in other markets. I always tell this story. I was at GIC during the first weeks of COVID, and I remember getting on the phone with our CIO and CEO, and they went through each of the portions of the portfolio, and there's bad stuff happening in private equity, there's bad stuff happening in real estate, and they get to infrastructure and they go, well, tell us about all the bad stuff going on in your core infrastructure portfolio. And I say, well, the utilities are still producing power, the cell phone towers are still running, the railroads are still moving, essential supplies around the country. Nothing's going wrong here. And I think that is what core infrastructure needs to deliver, and it's sort of fundamental to how we think about investing in the space. Of course, yield is part of that, downside protection, that we're taking about half of our return in the form of yield, which just de-risks us every day. And of course, highly diversified, even compared to fixed income, certainly diversified against other equity investments, but actually, I think core infrastructure is a nice diversification even compared to fixed income. Slide 7, talked a little bit about this, but there is this historical underinvestment in infrastructure, but even more than that is this growing opportunity around, I would say, digitization of the world and reindustrialization of the US economy. What we see is growing industrial investment, and that growing industrial investment requires quite a bit of investment in power and logistics. So all these new factories and all these new chemicals plants, what's going to power them? We're going to need a lot more electrons of every form and fashion, more wires to move them. And then, of course, we're going to digitize more and more. All of us use more data every day. More of the world is moving. And as you think about how we use digital tools, we expect them to be 5 nines of reliability. It used to be that we accepted dropped calls, we accepted slow and buffering video. But as we now use these things for business meetings and for other essential services, we really have a need to invest in sort of the hardening of that digital infrastructure. You see this on slide 8, where the growth of power around the world, data around the world, and reshoring and nearshoring. I mean, these 3 trends, which really are global in nature, we see them in the US, we also see them in Europe as well as elsewhere, and they're increasingly intertwined. As you develop more industrial sites and you're doing more of that kind of production, you need more power. And as you develop more digital infrastructure, that needs more power. And so these things do, frankly, build on each other to a large degree. Moving to slide 9, that really informs kind of our active core infrastructure strategy. So we really focus on 3 sectors: the energy sector, power, utilities, water, transportation, and digital infrastructure. We're looking to buy companies that serve essential services to society. So they're asset-backed, highly contracted, very stable, predictable earning streams with good cash yields. But we don't just sit on our hands. We are looking for businesses that we can improve. And so that allows us to generate a target net return of 10% and about a 4 to 5% cash yield. I think we're well on track to delivering that. We delivered about a 5.5% cash yield in our current fund up to this point for 2025. And I think importantly, compared to some of our peers, we're really focused on control investments. Because our approach is a more active approach, we really have to be the ones who can control the businesses and bring our value creation playbook to these companies. Slide 10 talks a little bit about sort of a mature open-ended portfolio versus maybe a cleaner, newer one. And I think that the moral of the story a little bit is you want a little bit of both in any portfolio. Mature open-ended portfolios that are large and more scaled, you have a lot of assets and diversification in those today. That's good. The downside of that is you probably also have a lot of assets that were invested in the low interest rate environment. And so as those portfolios have grown, another $40 and $50 billion, some of them, it is hard to kind of compound those returns at high returns going forward that reflect the current interest rate environment. Whereas kind of an open-ended portfolio that's newer and cleaner and younger, what you're going to get there is more capital appreciation in the early years, higher returns in those early years as the portfolio kind of grows, and more alpha is generated probably in the upfront period of time. But I think there's pros and cons to both, and a good portfolio will have both in them. Slide 11. So as I mentioned, we don't just sit on our hands. We want to buy businesses that we can improve. And so, on the right side, there's sort of 2 little highlights, and we'll get into these in a little bit more detail. But Grupo Osea is a business in France that we will talk about a little bit more detail. But it's It effectively does metering of heat and hot water in homes in France, which by law each have to have their own heat and hot water meters. What we like about this business is it's a 100% inflation-linked business with long-term contracts. Contract periods are typically 11 to 12 years. So every time we invest a single dollar in a new meter, what we're getting back from that customer is an 11-year inflation-linked string of cash flows back that pay back all of our capital investment plus a return on that. That's the kind of business we love. But we don't just sort of do that. We're also trying to improve these businesses. So we're trying to bring new digital tools to make the field workers more efficient. We're trying to route optimize so that when they're going out and installing these assets, maintaining these assets, they're doing it in the most efficient way. To do that, we do have to be in kind of a control or co-control position, and that's some of the value that we can bring to these portfolios. Slide 12. This is an overview of the kind of portfolio of our Fund 1 and kind of where it sits today. Five companies, and that's hopefully signing a sixth investment here before the end of the year. Nicely diversified geographically and sectorally. A nice mix of kind of US, UK, Europe. We like to be more of a global fund because it actually allows us to find business models that aren't available everywhere. I mentioned the metering business in France. That's a business model that just doesn't exist in North America. Likewise, in North America, we really love freight railroads as a really, strong play on that industrialization theme. But in Europe, it's really hard to invest in freight railroads because they don't typically own the rolling stock, the track, and the yards. It's all split up, and government owns some. So you kind of can't create that same business model. So we like being able to look across some of these different markets, all of them high quality geographies, but they offer different aspects and different business models that can fit with our fund. Page 13, a little bit overview of the team. The Active Core leadership team is 3 dedicated partners, myself, one in the UK, Kunal, and one in Germany, Fabian Grone, as well as supported by the sort of full 140 investment professionals, a team now of almost 25 partners, and 6 managing directors who pretty much spend all their time focused on the core infrastructure market alongside of us. So a really broad group of folks. And the flags, I think, what's interesting about the flags is it sort of shows that locals with locals approach, that we're in all of these markets finding unique opportunities that maybe are not uncovered by others because we are, boots on the ground in Madrid and in Milan and in Tokyo and all these different markets. Slide 14. So we've touched on some of this, but I think the real key here is how we kind of, source opportunities. So we start with those local boots on the ground and that sort of sector expertise that we have across all of our funds and all of our investment professionals. But what's really important is the industrial advisors that I mentioned. When we have an idea of a sector we want to invest in, what we do is we look through that network to find people who really know and understand that sector. So that could be former executives who have worked as operating executives in that sector, but could also be the customers who have used that infrastructure on the customer side, or regulators who have been the regulator of that infrastructure. And what that really does is it gives us a 360 view of kind of how these businesses create and bring value to the ecosystem. A good example is, we were looking at a chemicals terminals business, and we were looking at it in partnership with the former CEO of their largest customer. So he had been the biggest customer of these facilities. He could tell us down to a very micro level, these assets I absolutely must need. I could not run my factory without them, my plant without them. These over here in this other market, I could probably get around those. That kind of insight is something you can't get any other way. And it gives us a distinct edge and really angle to kind of create value in the businesses that we buy. Moving to slide 15. Once we buy a company, we still continue to work with those industrial advisors. One of the first things that we do on the right side of the page is the full potential plan. So with every company that we acquire, the first 100 or so days, our board, our management team, and the EQT partners basically are working on what is the full potential that this business could deliver. So even a really stable, kind of predictable core infrastructure business like a utility or a railroad, we're still looking at those and going, on both the revenue and the cost side, how do we optimize? What more can we do without adding risk? And I think that's really the key point. We will not add risk when we do these things, but it's about, can we, get better pricing from this customer? Can we offer a new service to this customer that they're not using today? Can we become more efficient on the cost side by optimizing how we procure different things. That's what the full potential plan is all about. We create that plan sort of in the first 100 days of ownership, and then that becomes really the model that the board, the management, and us are all focused on driving going forward. On page 16, I kind of mentioned our industrial advisors. This is sort of an overview of some of those folks and kind of how they work with us. Starts with the sourcing of ideas, through the due diligence that we perform on these companies, and then, as I said, all the way through to kind of the value creation and the ownership. They sit on the board with us and are sparring partners and advisors to the management teams of these companies. So whereas many other firms kind of, the board is really the investor, we are on the board, but we are on the board with this pool of industrial advisors who bring a unique and differentiated perspective for the management teams and to help the management teams. So, sorry, that was quite a bit, I'm sure, to digest, but that was my remarks.
Any questions from board members? Go ahead.
With economic development continuing to grow in the U.S., especially in the Southeast, Mississippi being a big receiver of that, hotbed of energy, digital, transportation. Can you give some examples of opportunities in the Southeast, specifically in Mississippi, and will this continue? And with locals, how does that work in the Southeast and opportunities in this area?
Sure. I think that the economic development is going to wind up in the states that welcome the economic development. So the states that are actively trying to sort of court these opportunities with a mixture of, electricity, frankly, is the biggest constraint, and then logistics, road, rail, ports. That's going to be the winning combination, I think, over the next at least 5 or 10 years to really attract this investment. And it, like I said, it really does build on itself. If you can deliver power, get people power on time with interconnections and things like that, then you're much more likely to site your facilities there. And then, of course, you need the logistics as well. The way that we do it, a couple of different ways. I mean, obviously, large team, mostly in New York, but we also, through our real estate side of the business, have local offices in pretty much every state in the country. Those folks really help us when we're looking at a railroad opportunity, let's say. I can go and call those local real estate folks and say, I'm looking at this rail line and it runs kind of along this path. What do you think of those places? Is that an area where I can get multinational Fortune 100 companies to site? Because is the land permitted properly? Does it have road and rail access? Does it have power access? And those local real estate folks are really a unique tool that we have. Most others don't. And so that kind of really helps us inform. And to your point, I think the Southeast U.S. is probably the hotbed of a lot of this growth, right? Because it has good access to labor, it has good power, it has good access to road and to rail and to water. I think that's going to be a lot of the opportunity set, but it is something that we have to see how that kind of evolves over the next couple of years.
Thank
you. John?
So if you were going to single out the largest area of risk and lessons learned or mitigants that you've employed in your process, what would that be?
Yeah, I think one of the biggest risks that others maybe in the space don't focus on that we do and we've avoided would be single asset concentration. And what I mean by that is if you think about core infrastructure, it's very easy to sort of invest, or many people think of a toll road, an airport, a single power plant, a single asset. And what we don't do a lot of that, and we avoid it for the reason of the problem with those is, one, you can wake up to bad news. A counterparty, a customer terminates a contract. It's very hard to change that single asset and make it do something else. A toll road kind of serves one purpose. It connects one area. However, a company that maybe owns 20 toll roads around the world or 20 power plants, that has real value to the ecosystem. If a customer over here terminates, it's not great, but it's a small piece of the portfolio. And I have a team of people who can commercialize and find another use case for that site, right? So we really prefer companies as opposed to single assets. And that's something that I think others maybe in the sector don't fully appreciate. So that's a big risk that we've really sought to avoid in our portfolio.
Thank you.
Other questions from board members? Charles, question?
I have none.
We thank you, Alex, for coming and sharing with us today, and appreciate it, and we'll be discussing this further shortly.
Thank you so much.
Thank you. For coming in. Your home office is in New York. Here. Looking forward to hearing your next 15 minutes presentation, and then allow us for a few moments for questions or any further explanations that we may ask for. So we're going to turn it over to you all to introduce yourselves, and we do have your materials. Just give us a page number and we'll follow along with you.
Thank you.
Absolutely. Well, good afternoon. Thank you very much for inviting JP Morgan to participate to talk about our Global Transport Income Fund today. I know we have about 20 minutes, 15-20 minutes, so we'll stick to that. But before we begin, we just want to say thank you very much for the relationship. I've been with JP Morgan and the Mississippi relationship for about 20 years. You know, we really appreciate the relationship we have on the core real estate side. And I'm in the client advisor seat within JP Morgan Asset Management, where I basically help to kind of bring the relationship together from an asset management side. But we do really appreciate the time here today. We're going to spend some time on our infrastructure fund. To the right of me, I have Anurag Agarwal. He's the head of portfolio management for the fund. He's one of the most senior members on the team, and he's also on the investment committee here today. So thank you very much again, and we'll kick it off as a presentation.
Thank you, Anne-Marie, and again, good morning. I just checked, it was not yet noon, so in 11 minutes. Maybe I'll just start us off with slide 2, which helps set up exactly where in the world of broad infrastructure we live, because I know you're hearing a lot of different ideas from the broader infrastructure world. So this strategy is focused on transport. And the way I always like to think about transport assets through the lens of infrastructure is just think of this strategy focusing on moving assets. So the simple rule of thumb is if it moves, it's core transport, which is our world here in the strategy. And if it doesn't, it's the more traditional infrastructure world that you've probably heard of from some of our colleagues in the industry before this. So for example, if it's an airport, it's infra. If it's aircraft, it's us. If it's ports, it's them. If it's ships, it's us. So I use a very simple logic of a 3-year-old. If it moves an inch, it's mine. And if it doesn't, they can have it. But that just helps separate the assets. Now, it's an important distinction because what's really important to understand is while these assets are symbiotic to each other, they are negatively correlated when you put them in a portfolio alongside each other. So one of the greatest objectives that core transport will help achieve in a portfolio that has an infrastructure focus is that of diversification, not just to public equities and public bonds, which is why you come to the private markets, but within infrastructure, you get that negative correlation. And that is certainly something that we like to highlight. So this is a strategy called the Global Transport Income Fund. Our team has been around for a long time, over 15 years of investing in this space. We've invested in this strategy about over $6 billion, but in total, close to 9 in the sector for the last 15 years. And we are one of the world's largest, if not the largest investor in diversified transport as we speak this morning. So we're very proud of that achievement. I'll talk a little bit about performance as we go along. So just to flip to slide 3, this is where we live in a world where you're looking for two things: income and diversification. So on the left of the page, you see the bubble or the big bubble that says transport. You see all other asset classes here, real assets in blue, in dark blue you see infrastructure as well. And here is where you see the point, which is what has historically been proven is you can get a high level of income with the most amount of diversification, which you see on the x-axis as being negative, to the traditional 60-40 portfolio. And then here, because the two bubbles of infrastructure and transport are away from each other, you can see that they have negative correlation there as well. So I just want to show that through data. And then slide 4 shows you the actual metrics of diversification. So when you just follow that dotted yellow box across transport, I'm going from left to right, you can see, just easy way to read this chart is green is good. So the more green you see on this matrix, the more diversification benefit or negative correlation you're getting. So you can see green pretty much across all the asset classes. And again, the one to point to is the global infra correlation is negative 0.1. So this is just an important enough point that I wanted to add a couple of data-based slides to show you where that correlation comes from. So now we can focus on the business itself. So on slide 5, we will look at what exactly is it that we do in this fund. In one word, it is leasing. So we all understand the business of leasing. We are one of the world's largest lessors, and we are solving a very simple problem. Every large global corporation in the world that has a physical good, product, or commodity, energy majors, Shell, Exxon, BP, Total, mining companies like Rio Tinto, BHP Billiton, ArcelorMittal, Siemens, Cargill, Koch Industries, Amazon, Walmart, anyone that has a physical good needs to transport that physical good or product from the point of extraction or manufacturing to their customers. So a little known fact is that 85% of everything in the world that is consumed travels on a ship at some point. This is a fact. And I often like to say if it doesn't float, it flies. So transport, even though it represents less than 3 to 4% of the total cost of a supply chain, it is the tail that wags the dog. Because without the transport, we wouldn't have 80% of all the things we are used to consuming or take for granted that show up at our doorstep. So that is the significance of the asset class, which is why it is a core asset class, core and essential to society and trade. We focus on 3 attributes when we make investments in such transport assets. We look for the largest assets that are deeply embedded in the corporate supply chain of these large end users. That's really important to us. We will not buy assets speculatively. We do not like to take bets on assets in the hope that we will employ them. We buy assets and employ them at the same time. And that gives us predictable revenue, which is what we're after. 2, we look for duration. The longer the duration, the more we get in terms of predicted cash flow, which is important for cash yield. So this strategy focuses on a higher level of cash yield, 8 to 10%, target cash yields, 10 to 12% total return. So a lot of your return will come from income. That is the stated focus of our investment activity. And then finally, we care about who we do business with. We do business with the world's biggest corporations. Why is that important? Because our leases are structured as legal obligations called take or pay contracts. And this is, again, super important because what that does is it shifts all the risk from the operating side of the business when the lease is signed to actually the credit of the end user or the counterparty with whom we are doing business. Because take or pay says, once I sign a lease with you for 10 years, let's say you're a large corporation, Shell. For 10 years, all I care about is the financial solvency of Shell, which is the same credit risk you take if you buy a corporate bond issued by this issuer. So it is a very elegant way to access high quality corporate credit. And in our case, what we've noticed is you can outperform corporate credit by about 400 to 500 basis points through the leasing approach. So take or pay contracts that get treated as a current liability, so we get paid very senior as a priority obligation. And of course, the criticality of the asset gives low volatility to the performance. And that's really what we are all about. The team, on slide 6, this is a team that is dedicated at JP Morgan Asset Management that only focuses on transport. This is the only fund we have. It's an open-ended vehicle, which means we raise and deploy capital every single year, and that is all we focus on. My partner, Andy Dacey, and I launched this business in 2017. We did this because we saw a huge opportunity after the GFC of banks that were the traditional providers of leasing capital being forced out of the business because of regulation. I think we all remember Dodd-Frank here in the US. So that created the opportunity. We were the first to market, and today we are one of the largest. So we raised about $7.5 billion since 2017. And today we have investments in 16 different industries of transport and one of the most diversified portfolios of transport assets that you can see on slide 7. Just some quick metrics. In one portfolio today, we have investments across 9 different sectors of maritime and shipping. We are the world's 6th largest ship owner, so in the top 8 percentile of ship owners in the world. We are also owners of a business that is the 6th largest container box leasing business in the world. We are also the 10th largest rail car leasing business in North America. We are the largest EV charging platform in all of Europe. And we own a business that is the #1 provider of public transport to the country of Denmark. We just acquired a business that is also the 3rd largest ship management business in the world. Now, all of these live in one portfolio, which means that when you invest in a fund like this, day one, you will own a piece of everything. And that is about 160 odd investments that have been made that include 180 ships, 12 aircraft, 20,000 rail cars, 150,000 EV chargers, 750,000 container boxes. All of that is included in one portfolio, and that's where the diversification comes from. Performance, that's what we're here to talk about. This fund has had a very strong track record of 7 years worth of performance, whereas you can see on slide 8, regardless of whether you look at us on a 1-year, 3-year, 5-year, or 8-year basis, we have produced 8.5% net cash yield every single year for our investors. In fact, the one metric we care about the most is our quarterly cash yield. And for 32 consecutive quarters, or 31 as of the 3rd quarter this year, we have distributed 2% or more net cash every single quarter to our investors. That is performance that has been delivered across all the things that have happened in the world from 2017. So there was the pandemic, as we know, there was the Russia, Ukraine ongoing war, the Middle East crisis, rising interest rates, inflation, the tariffs and trade. Through all of this, this fund has never lost $1 of revenue and has consistently delivered 2% net cash every single quarter. And the historical volatility of that performance is 2.6%. So very low volatility-based, predictable income is really what we focus on. A lot of that comes from credit, as I was saying earlier. So when you look at the average credit exposure the fund takes, we have 46 unique global corporations with whom we do business today. Their average credit rating is A-. So we're a fund producing 8.5% cash yield, taking A- equivalent credit risk. And that's where a lot of the resilience comes from. Just to talk about, just as I look at time and to leave enough time for our questions, I want to focus on concentration risk, which is on slide 8. So what can go wrong? What can go wrong in the leasing business is too much capital in a single asset, too much credit risk to a single counterparty, or too much renewal of leases happening in a single year, right? So this is a business where size matters. The bigger you are, the more diversified you are, the more you are able to mitigate some of the concentration risk. So these 3 numbers in percentages on slide 8 are the numbers that I, as a portfolio manager, obsess about every day, because that tells me how much concentration risk I have in the portfolio. Quickly walking through those today, 153 investments means no single investment has more than 0.7% of the fund's capital invested in it, 0.7%. That is about 6 basis points worth of risk in the total performance of 8.5%. Credit, 46 counterparties, average is A- credit, but even then, average credit concentration is 2.2%. That's again about 12 to 15 basis points worth of performance risk. Our #1 concentration of credit is about 13%. It is to a large sovereign-owned oil major with an A rating, and our #2 exposure is 10%. So very, very low credit concentration. And then finally, renewal of leases, which is, of course, in the leasing business is important. Average lease duration for us is about 7 years. That is again important because assets in our business have a 25-year life. So we're looking to lease an asset no more than 3 or 4 times in its life. And in any given year, we have less than 5% renewal. That's again important because 5% renewal tells you it's only 5% of the portfolio that will face the market. So if things happen in the world, which they will, we can be sure about that, only 5% will face that market condition, whereas the other 95% of the portfolio is contracted take or pay to produce that income. And that is why you have on slide 9 what is, to me, a very important way to think about this strategy. This is the comparison. We are the orange line. So when you look at this slide, it was actually done for a board much similar to yours, where we looked at all the other asset classes in comparison based on index performance, going all the way back to 2017 when we launched this fund, and we plotted that performance to show how we've done on a relative basis as an asset class and as a fund. And what you see today here is that the orange line, firstly, is the second best performing asset class over the last 8 years. This is the actual performance of this fund. Now, normally you would say a silver medal is not great, but I'll take the silver medal happily, only because we're second to equities, and equities should be your highest performing investment. Equities, however, had a 15% volatility over the same period of time compared to our 2.6%. So much more lower volatility with this performance. And then finally, what you see here is the blue dotted lines show you all the world events that have happened over the last 8 years. And if I can just point you to the first one that shows the COVID-19 pandemic, because that's the one that we all like to think of as where we were all of a sudden surprised with a major global event that was adverse. You can see all asset classes pretty much took a big fall in the second quarter of 2020, but the orange line actually went up. The same thing happened when now we're seeing stress in the Middle East because the Suez Canal, which is an important trade passageway, is not available because the Houthis are allegedly active there. Transport actually has historically benefited from geopolitical adversity and supply chain stress. Why? Because you can't build ships and planes overnight. So because it takes 4 to 5 years to build a new asset, when there is a huge contraction of what happens, geopolitically because of supply chain stress, we see transport assets being used even more. For example, right now, ships are going around Africa to go from Asia to North America, as opposed to the shortcut through Suez Canal. Why does that matter to me? It takes 14 to 20 extra days now to do the same job. So we get paid more for a longer period of time to deliver the same goods. In the pandemic, we saw the same thing. There was no labor, lots of congestion at ports. It just meant that ships were waiting outside to pick up and drop cargoes. We get paid on a per day basis. So the longer it takes to do the job, the more we are in a better position as owners. And that is why this asset class has historically had an inverse relationship with geopolitical events and macroeconomic risk. So in some portfolios, you can think of this as a good way to hedge against some of these events because none of us can foresee them. But the asset class generally tends to benefit. So maybe with that, just if there are any other questions, I'm happy to take them, but those were the prepared comments. We do have some case studies of some of our bigger investments in the portfolio, and then some slides on the broad views we have on the market. But really appreciate the opportunity to speak to you today. As Anne-Marie said, JP Morgan and my colleague Jeff Fox, who's not here today, have had a long-standing relationship with all of you, and we're really honored to be here today. Thank you.
Questions from board members? Okay, sir.
I want to say thank you for being here. Anurag, the board doesn't know this, but you came all the way from London to be here, but you're actually from Dubai, right? You live in Dubai?
Yes, as a transport guy, I can't complain about travel, but I do live in Dubai. So if there's an award for longest travel done, I took a wonderful 16-hour flight to Houston yesterday, and then had the pleasure of being here today.
Thank you.
Yeah, no, it's great to be here. Thank you.
And Jeff Fox is someone that the board knows. He is out of town, so Anne-Marie is taking his place today, and thank you, Anne-Marie. Anurag, I'd like for you to quickly tell a story of the airplane that was stuck in in Russia at the war, and to the sentiment that assets can draw income even in times like that.
Sure. So in Ukraine, actually, not Russia, thankfully. So we have a plane in the portfolio that was leased to Wizz Air, which is a large, low-cost carrier in Europe. Actually, investment grade, very high quality credit. So from a pure underwriting point of view, they're a great airline. We've got 3 aircraft on lease to them. Bless you. One of these aircraft happened to be the last aircraft that flew into Kiev the night before the invasion. And normally that would be a huge problem if you were relying to get paid based on the performance of that aircraft. However, it's been now over 4 years, and we have that aircraft is still sitting in Kiev, and we have continued to not see any impact on the expected income from that lease because of that take or pay nature of the contract. So as I said earlier, the definition of take or pay is I am not connected to the utilization of the asset, whether you are being able to use the asset or not. If you've rented or leased the asset from us for the entirety of that period that the asset is contracted, you are obliged to pay us the contracted rate. And at the end of the lease, you are now obliged to return the asset in the same condition that you took it, which unfortunately in this case may not happen. So then they will have to pay us for the remaining value of the aircraft. So just think of it as, I like to say Hertz. You rent a car from Hertz, you drive off, you pay for the fuel. If you have a bad day and you run into a tree or something, you just have to pay for the car and the damage you did. But the expectation is you will bring the car back with the fuel. So it is a similar-ish business. Just think of us as an industrial leasing company.
Other questions? No further questions, so we thank you for traveling.
Thank you.
Did you come on one of your assets?
I did not.
Okay.
I did not. We actually do have an aircraft on lease to Emirates Airlines, but I was not on one of those.
Okay. Thank y'all so much for coming down, and we appreciate y'all being here, and we're going to discuss this further very shortly, so we appreciate it, and thank y'all.
Thank you, sir. Thank you for your consideration. Thank you.
Infrastructure manager presentations, we've heard from all 4 of them. Any further comments that y'all want to make? These 4 are the recommendations for the $150 million per each one of these groups per our investment opportunity here. That's correct?
That is correct.
Yes.
I will say this, one of the things that I was surprised of before these folks did give us their presentations is that the selection of each one of these 4, they are a little bit different, every one, and they do seem to complement one another in covering this arena. So I think that's a great job y'all did with this. So, any further questions of staff? Mr. Higgins, anything?
No, sir, no.
Motion to approve the 4.
Got a motion? Second?
Second.
We have a second. We have a motion and a second. Any further discussion? All those in favor of accepting the recommendation of staff for our core infrastructure managers, if you would say aye. Aye. Those opposed by like sign? There being none, they are approved. So, we're going to break for lunch now. It's 12:12. Do we want to break for lunch, or does this other group need to go back?
Well, we certainly could, but that's what I was going to ask about. Do you want to take up the MFS first, or?
I was hoping that we could take
Hear this
up.
group?
Yes.
It would be up to the board.
If it's okay with the board.
Board members, are we okay for another 20 minutes? Do we need 5 minutes before the 20 minutes?
Let's move forward.
Okay, we will move forward then. We will go back to number 3, I guess.
Yes, sir.
Okay?
Thank you, Jason. The next item on the agenda is a Acqui ex-US search, and this is a search that was done to replace Belly Gifford. I have Ryan Holliday here to give you just a short overview of the search process that we did and who's coming in to speak to us.
Okay, Ryan?
Good afternoon. So as Charles said, this is to replace Valley Gifford. It's been a search we've been doing for about 4 months now. There were a lot of good candidates, but MFS stood out the most to us. Got the memo you can look over. It's led by Matthew Barrett and Kevin Dwan, two very experienced portfolio managers. And one of the things that stood out to us for MFS is just how broad the firm is. I mean, they've got 125 fundamental research analysts, 8 global sector teams, 98 portfolio managers, and 16 quantitative analysts. So just great coverage. They're a firm that's been close in other searches before, but I think we finally found the space for them here today. And I'm happy to answer any questions. If not, I can get them and let them present.
Any questions on this introduction?
Okay,
Bring them in.
I will get them in here.
Billy Gifford, I guess. Make that, need to call our old board member.
We're glad that you all are here. We're looking forward to hearing from the MFS International Growth Equity Group this day. So we're going to turn it over to you all, and if you would, 15 to 20 minutes, that would be great for us.
Excellent.
And we do have your materials, so you just let us know what page you're on. We'll follow along.
Fabulous. Excellent. Well, my name is Greg Jones. I'm a member of the institutional relationship team at MFS. I'm based in the Philadelphia area, but I'm responsible for new business development in this area of the country. With me today is my colleague, Brett Fleischman. He is institutional portfolio manager on the international growth strategy that we're here to talk about today. So again, thank you for your time. Appreciate the opportunity. Hope we can give you all the information you need to make an informed decision about our firm. I'm going to kick us off with some brief comments. We can go to page 6 to start things. I'm just going to share a couple of quick things about MFS and then hand it off to Brett to spend the bulk of our time here talking through our investment strategy. If I can give you two things to remember about MFS as an organization. One, everything that we do is built off of one global collaborative research platform. So we don't have, boutique teams operating separately from one another. We're one cohesive investment platform. So we have dedicated portfolio managers that manage strategies like this, but they are leaning heavily on that global platform. Secondly, we take a very long-term view in the way that we invest and in the way that we manage our business. So we tend to have much lower turnover in our strategies, much longer holding periods, and we have a really keen eye towards succession planning when we're thinking about how we're managing these capabilities. If I could ask you to move ahead quickly to page 9 before I hand it off to Brett. I mentioned that long-term investment horizon, the way that we invest. And if I could draw your attention on page 9 to the upper left-hand chart. This is looking at our rolling returns dating back to the inception of the strategy in October of 2001. And as you can see here, we've outperformed 100% of rolling 10-year periods back to the inception of the fund with an average excess return of 3.31%. So remarkably consistent investment performance over the benchmark when we've been given a full market cycle with which to operate. Now, that said, I recognize that this is our past returns, and what you're focused in on is our future returns. So my hope is over the next, 12 to 15 minutes, hearing from Brett, you'll be able to identify how consistently we implement our investment process, and that's what gives us confidence that we can replicate these returns on a go-forward basis. So if there aren't any immediate questions on anything I've said, I'll pass it off to Brett to talk through the team and process.
All right, excellent. Well, thank you very much for your time, for your consideration. We absolutely very much appreciate it. I'm going to pick it up here on page 10 and just briefly introduce a few members of the team. I'm happy to answer any questions about the entire group that's on this page, but I'm just going to focus on the left-hand side of page 10 and specifically introduce both Matt and Kevin. I'm actually going to start with Kevin. He's been at MFS since 2005. He started off as a research analyst, and he has been managing this strategy since the beginning of 2012. So at the end of the year, he will have been on the strategy for 14 years. Kevin is based in our Singapore office. I always say that and think to myself, is he really based there? He travels more than anyone at our firm. So he is probably traveling more than half of the year, and he's in all the different offices, and he also spends some time in Boston, which is where we are headquartered. Matt Barrett, who co-manages the portfolio with Kevin, is based in our London office. He's been at MFS since 2000, and he also started off as a research analyst, and he has been managing the strategy with Kevin since March of 2015. So the two of them have been co-managing it for more than 10 years, and Kevin has been on the strategy for almost 14 years. Every decision is made collectively. They don't break up the world by geography or by sectors, and so there has to be consensus on every decision that goes into or out of the portfolio. If we look at the next page, 11, this just gives you a little bit of a feel for who we are and maybe by inference who we're not. Greg already made reference to this, and I would say that if there were two words you would use to describe MFS as a firm, it would be long-term and high quality. And I think that those very much apply to this strategy. If you looked at our portfolio at the end of September, our average holding period was just under 7 years. So when the market is very short-term and focused on the next quarterly release, the next inflation number, what's happening this particular quarter with AI news, it's not that we're ignoring it, we're absolutely thinking about it, but our time horizon is much longer, and we think that allows us to make some differentiated decisions relative to the market, which tend to be very, very short-term oriented. The second point I would make is that the quality aspect. No manager is going to walk in here and say, we're looking for really low-quality businesses. That doesn't resonate particularly well with other investors. But the way we think about quality, I think, is a little bit different than the market generally does. The market often thinks about quality as the stability of earnings, right? If companies have more stable earnings, less variance in earnings, that makes them good quality. And if they have more variable earnings, that makes them sort of lower quality. We don't subscribe to that because there are lots of companies that have cyclical end markets and therefore more cyclicality in their earnings that are very, very high quality businesses. So instead of thinking about the stability of earnings, we think more about, are these companies that have moats around their business that will lead to above average returns on capital? And if you look at returns on capital relative to the cost of capital, will they be able to continuously earn a spread above the cost of capital? Those to us are the highest quality businesses, whether they are more structural and defensive in nature or more cyclical, as long as they can do that over a full cycle. So that's how we think about it. Ideally, the company will have an intangible asset that they invest behind. So it could be a consumer staples company that spends a lot on advertising and promotion to build brand equity. It can be a pharmaceutical company that invests heavily in R&D to hopefully have a rich pipeline of new drugs. So that's the way we think about quality. Stability of earnings is certainly important, but it's not, in our mind, the only thing that matters in terms of quality businesses. For us as a growth manager, you can have different hurdles of growth. We would describe ourselves as quote unquote conservative growth. We're looking for above average growth relative to the market. If we think about revenue growth, that typically means companies that can consistently grow in that mid-single digit range. So 4, 5, 6% top line growth. We're also looking for companies that can concurrently grow their earnings in the high single digit to low double digit range. So broadly speaking, 5% revenue growth, 10% earnings growth. Those are not the names that necessarily are going to get you excited when you're out with friends talking about the next great idea, because investors like to hear about these companies that are growing at 50%. It's 50% growth and they can do it for the next 5 years. You got to get into this company. We get nervous about companies that are growing at 50% a year, because often the rate of growth and the duration of growth is overestimated by the market, and simultaneously the market is paying up for that perceived very high growth rate. So we're identifying companies that we feel very confidently can grow a little bit faster than the market consistently over a long period of time. But the benefit of our approach is we don't have to pay these exorbitant, very, very expensive multiples for above average growth businesses. And what that leads to is a portfolio overall that is very long-term, very high quality, above average growth, but also very valuation disciplined. So with that, I wanted to actually move ahead to page 14 very briefly and describe how we perform in different markets, and hopefully this will dovetail with how I just described our overall approach. This looks at the All Country World ex-US Index. It looks at the quarterly returns going back since the inception of the strategy. And then what we're doing here is putting together every quarter that has a performance stream with a similar stream together and looking at how we do in those different markets. So on the far left-hand side of page 14, these are quarters where the index is down a minimum of 5%, if not more, in a single quarter. So really challenging markets. The dark blue bars represent a period where we outperform. These are all net of fees. The light blue is a period where we underperform net of fees. And so what you'll see here on the far left is that we have extremely consistent downside protection in really challenging markets. And I think the main reason for that is because there's a very strong high quality bias. So if you're an investor and you're nervous about what's happening in the markets for whatever reason, and the markets are going down, but you want to stay within equities and still have exposure, it's natural to gravitate towards the highest quality businesses. That's our portfolio in general. Now, it's not to say we need this massive sell-off to do well and add value for our clients. If you look at sort of normal markets, and we define that as up or down 5% in a quarter, we still outperform the vast majority of the time. I should note that the numbers you see in this gray rectangle towards the bottom, so under market return of -5 to +5, it says plus 0.25. That's just the net of fees outperformance in those quarters. It's not an annualized number, so it's not going to match what Greg described earlier in the presentation. It's the very strong up markets, up 5% or more in a single quarter, where we wouldn't expect to outperform, nor have we historically. And this year is a perfect example of it. Typically, not always, but typically, in very strong up markets, it's less about actual fundamentals and more about investor optimism, more about momentum. And in those market environments, low quality often not only outperforms high quality, but often by a significant magnitude. So that's the reason why we perform the way we do in different markets. You add it all up together, and we've had very consistent performance over a very long period of time. If you look at upside downside capture ratios, and you'll see this later in the presentation, whether against the core index or the growth index, we typically capture 100 to 103% of the upside. So we fully participate in the upside overall. But the beauty is we only take 89 to 92% of the downside. So we do very, very well protecting client assets. In the interest of time, I'm actually going to just continue on to page 15. This shows our sector positioning, and we highlight both our relative positioning versus the core index as well as the growth index. A lot of plans will look at the ACWI ex-US index to measure their non-US managers. We're very comfortable managing towards against the core index or the growth index. For internal purposes and for the way we think about risk management, we typically look at it relative to the growth index. And so that's why you see both variations on page 15. Our overweights and our underweights are typically going to look fairly similar versus either index. Financials is much larger in the core index, and that's largely banks. So you'll see a notable difference there. And you'll see a few other small differences, including information technology and industrials. If you have specific questions, I'm happy to highlight why those look different. The important point I would make on this page is we're not top down and we're not making macro calls and repositioning the portfolio around our perceived forecast for what will happen in the next 12 months. These weights reflect our buy criteria. We're looking for companies that have above average growth, which I already described, high returns on capital, generate a lot of free cash flow, reinvest that cash into the business. What that leads to is us being overweight areas that are typically growthier and also less capital intensive, and underweight areas that are less growthy and much more capital intensive. With that, I was just going to talk very briefly about the regional exposures on page 16, and then intentionally stop to see if you have any questions specifically. So on page 16, we show our geographical exposures both by domicile, also by revenue. If you look at it by domicile, and that's, you know, the way most people will report this, because revenues can be reported without explicit standardized segmentation. You can report it in different ways, but we feel very confident that the revenue exposures are accurate within, you know, plus or minus a couple percentage points. The domicile that you'll see here on the left-hand side, you'll notice that 30% of the index is in emerging markets. So companies that are domiciled in emerging markets. And this is an interesting quirk with MSCI. They've got MSCI EFA, which has 0% EM direct exposure. And then they have ACWI ex-US, which is 30%. And they really don't have a mix that's sort of in between those two. In our portfolio, we have a lot of direct EM exposure. In the past 5 years, it's been between 15% and 24%. But because the index is 30%, we are underweight relative to the index. Within that underweight, the biggest piece of it is our underweight to China. And if you are interested, I'm happy to talk a little bit more about why we are underweight China. So with that, in the interest of time, recognizing that you are probably all very hungry at this point, I'm going to stop, and I'm happy to answer any questions that you have on any of the things we've discussed or anything that's on your mind more broadly.
Questions?
I don't have a question. Do you have? I guess there are none.
Alex? Oh, no question there, okay. Don't believe we have any questions at this point, but if you'll continue. We may come back to that China issue in a little bit, but go ahead.
Yeah, the last page that I was gonna just mention briefly is page 17. There's a lot of data on this page. We apologize for all the numbers, but I mentioned before that we are what I would describe as a more conservative growth manager. So we are finding above average growth companies, but those sort of high octane, more momentum growth companies, we tend to shy away from. It makes us more nervous and weary about the likelihood of continuing to grow at those rates over a long period of time. So if you look on the top left-hand side of page 17, it won't shock you to see that our growth rate is a little bit lower than the growth index, but also higher than the core index. That's not shocking given our overall approach to investing in growth stocks in this space. You'll also notice that our valuation, the price to earnings, is less than the overall core index, growth index, but a little bit higher than the core index. So again, it sort of makes sense, given that we are a growth manager, that we would have a higher valuation and a higher growth rate than a core index, but a little bit less so than the growth index. We mentioned about being very long-term. You can see the turnover here is 14% in the past year. If you look over the past 5 years, our average turnover has been 20%. So we are very long-term oriented, and that's been very consistent. This has been a more challenging year because low quality has massively outperformed high quality, and we have a high quality bias, but we haven't changed who we are. We haven't tried to chase returns, and that is why you see the turnover remain very consistent, even this year relative to past years. And then just the last thing that I would reemphasize, I'd mentioned it before, but the upside capture and the downside capture versus both the core and growth indices is also listed there, but I mentioned that to you previously. So with that, Greg, I don't know if you have any closing comments or anything else to add?
Just say we're very excited about the potential of partnering with your organization, but we're here, we tried to gear this conversation around what you can expect from us, but happy to dig into any issues if you do have any specific questions before we depart this afternoon.
And I might owe you something on China.
I want to know more about the underweight that you were talking about.
Sure, to China specifically, yeah.
Yeah.
Yeah, so this has been a very consistent underweight for a long period of time. So this is not a new view that is based on, tariff disputes or, AI and chip exports and, IP and technology. This has gone back 10 years. For us to invest in China directly, we need 3 things to happen concurrently. Okay? One, first and foremost, independent of where it's domiciled, it needs to meet our buy criteria. So I've already gone through that with you, and that's a prerequisite. The next thing is it can't be in a business or an industry that threatens the regime. If you recall, it wasn't that long ago that the for-profit tutoring industry literally overnight got wiped out. Everything went to zero because the government didn't like what was happening within that space. And so these companies essentially became worthless. So not only do we not want to threaten the regime, we also ideally want to find companies that are in industries where the regime would want to have more capital behind it. So for example, China has had a huge coal presence for a long period of time. Coal is a very dirty type of energy. It's very big in terms of fossil fuel emissions. So China has made it an internal mandate to try to reduce the amount of coal exposure and in that process increase the amount of gas exposure relative to their total energy production. Okay, that's China's goal. We own CR Gas, China Resources Gas, which is in the sweet spot of that transition. So it's harder for us to find names in China that check off all 3 of those boxes. It's not that we're not looking at China as a potential investment opportunity. We're just a little bit more cautious in our approach in that particular area. So hopefully that answers your question.
It does. Thank you.
Sure.
It does. Other questions? I think that we have no more questions. We appreciate your coming, spending time with us, explaining what you do, how you do it, and the purpose for it, which is returns for us if the time comes. But we do appreciate that. Appreciate y'all coming, and I hope y'all have a great rest of the day.
Excellent.
Thank you so much.
Thank you all.
Appreciate your time and happy holidays to everyone.
To make a change because something broke in the system. So one thing that I really like about MFS is consistency. I want a manager that's going to consistently follow their investment process. A manager that's consistently shown that they're able to provide alpha. MFS is consistently, for the last, since 2001, has 100% of the time outperformed in rolling 10-year periods of time. They said that they get nervous about owning really fast-growing companies. When I listened to them when we were interviewing them, I thought of baseball. You know, they have a really good batting average. And it's, you know, as with baseball, it's really exciting when you have a team that has a lot of home run hitters. That's an exciting game. And those type of teams generally win games, but they generally lose pennants. I want to win the pennant, and that's why we're bringing MFS to you. So I'm asking you to approve hiring MFS to replace Belly Gifford, and I think they're going to do a good job for us.
You've heard the recommendation of the staff. Do I have a motion for this company?
Motion.
Okay, we got a motion for MFS.
Second.
And a second. Motion and a second. Any further discussion? I will say this, in the data that Callan did provide us in the risk reward structure, it's like daylight and dark between this company and who we're replacing. In fact, Bailey Gifford, unfortunately, was almost off the chart down there. So I think our staff and Callan has made a good recommendation here. Any further discussion? All those in favor, say aye. Aye. Those opposed? There are none. So MFS has been approved as our ex-US manager.
Thank you, sir.
Yes. Mr. Higgins, anything?
No, sir. No, sir. Other than, as the committee, however long you would like to break for lunch, and then we've got a few presentations afterwards, right? That's the only thing.
Yep. 3 more presentations.
Yeah. Those are just for information only, though. That's standard.
That'll be number 6, 7, and 8 presentations for
Going
today.
back to the old days where we used to have that many.
That's
6
true.
or 7 a day.
That's right. Okay, we will recess and return after lunch. It is 12:41. I tell you what, I'm gonna hold y'all to school time. Let's try to make this 35 minutes if we can. That'll be close to 1:15 or 1:20 if we can do that. Okay, we're recessed.
I'll be here.
And who's in charge of letting Butch know that we've replaced Bailey Gifford?
Today, and David DeGuire is here to give you a overview of who's going to be speaking to us.
All right. Good afternoon, y'all. The three managers that are coming today represent the new mandates that were given 2 years ago. This is their first biennial presentation to this committee. So the first one will be SIT, who handles our short duration fixed income portfolio, and the short duration fixed income portfolio has been was put in place to help us manage liquidity and our cash needs, and generate income along the way. And SIT has returned in excess of 6% in very short duration securities since we've hired them. After SIT, we'll see two private credit managers. One of them is going to be Blue Owl, and you'll recognize one of the gentlemen with Blue Owl, Brant Gresham. Brant was a representative of PIMCO for years. He's been here many times, and now he's coming here with Blue Owl. But he's a familiar face. And so Blue Owl handles our private credit portfolio. It is primarily first lien, senior secured lending. And they originate these loans, and we participate in those loans with Blue Owl. And then the next that you'll see is GCM. Again, familiar faces for everyone, as GCM has presented here many times. But this time will be their first time to present for private credit. And again, they also focus on senior secured loans, and they give us the benefit of GCM is they give us an array of managers to choose from in that portfolio. So if you have any questions, I'll be glad to.
Yeah, can you read that?
You know, I think it says SIT, but I don't know.
Okay, I was just wondering.
But I'll be. I bet I know who can clarify it, and we can bring them in.
Okay, bring them in. We're ready.
Okay.
I think.
Fantastic.
Yeah. Good afternoon, everyone. Welcome to the Investment Committee of PERS. We're glad that you're here today to share with us about what you do for us and how wonderful your performance has been. And we're looking forward to hearing from you. So which of you gentlemen are going to start and introduce the rest?
I'll start. So I'm Patrick Magnuson.
Will you be Patrick?
Yes, I'm
Okay,
Patrick.
okay, very good.
I'm Patrick Magnuson, and I'm part of the institutional relationships team at SIT. I represent our fixed income strategies with large institutional investors like yourselves and their consultants. And then with me, I have two of our portfolio managers, Mark Book and Chris Rasmussen, who are part of the team managing your portfolio, and both of them have been at SIT for 25 plus years. I know some of you were here 2 years ago when we first were hired by PERS, but just as a reminder, SIT is an employee-owned investment firm. We're a manager of top-performing investment-grade fixed income strategies, and SIT today manages $19.5 billion, and our firm is based in Minneapolis, Minnesota. And before I turn it over to Mark and Chris, I just want to express our gratitude. We're extremely grateful and proud to be working for the state of Mississippi, and we're also very grateful to be here today. You pulled us out of the brutal Minnesota weather. It was 25 below wind chills this past Saturday, so we always love coming to Jackson, Mississippi, particularly this time of year. So anytime you want us to come speak to you in January, December, February, we will be jumping on a plane and down here whenever you like.
And we're about to freeze.
And I was just telling David, this feels like a spring day in Minneapolis, so we actually like this weather.
It works.
But yeah, thank you for having us.
You're welcome.
Chris, you want to kick it off?
Sure, we'll kick it off with information from your biennial report. Just a quick review of the strategy to start off with. So we manage a portfolio of high-quality, short-duration, taxable fixed income assets. The mandate is to ensure that you have significant cash flows available for liquidity events, which typically coincide with the beginning of December. So we manage the strategy to the liquidity needs as specified by your staff. The strategy itself, it has an inception date of almost exactly 2 years ago from these reports, so it was September 30th of 2025. So there haven't been any significant changes to the strategy since its inception. Performance has been strong, so you can see the performance on page 3. You can see since inception on an annualized basis, both over the last 2 years, and then obviously since inception of the portfolio has been a 1% annual performance. Year to date through October 31st of 2025, the portfolio outperformed its benchmark by approximately 1.36%, so that's 4.88% for your portfolio relative to the 1-year U.S. Treasury Index benchmark return of 3.52%. The strategy details start on page 6 and 7. You can see on page 6, the focus is to generate significant current income with a interest rate sensitivity mandate of approximately 0 to 3 years. We use a strategy that we refer to as our quality income strategy, equal parts quality and income. Half the portfolio is invested in high quality government securities. The other half of the portfolio in credit sensitive sectors like taxable municipal bonds, U.S. investment grade corporate bonds. The quality piece provides an anchor. It ensures the portfolio retains its value regardless of what might be happening in the economy or what's happening with interest rates. Well, the quality piece provides the income advantage that's driven out performance for the last 2 years. On page 7, the tab presentation number 3, it lists the assets. And we'll just skip to the summary at the end, page 17. This just provides a brief overview of what we invest in. I'll refer you to the quality box in the middle of the page. You can see about half the portfolio is invested in assets that are AAA rated or higher, and an income component making up the balance. You can see as of October 31st, the portfolio was yielding approximately 4.82% with a duration of 1.4 years. I'll turn it over to Mark to get into a little bit more specifics on how we construct the portfolio.
Right. You jump to page 29, actually. And Chris mentioned just a few seconds ago how important income is, and that's really what our focus is. Particularly with such a short duration, such a short average maturity strategy. We want to make sure that the risk is very, very low in this strategy. So we're looking at ways to generate income without doing it by taking interest rate risk. So if you look on page 29, you'll see during the 2-year period we've been managing your portfolio, the yield advantage over and above the benchmark. And currently it's about 1.1%, looking to the far right, but on average it's been about 90 basis points or 0.9%. And most of our strategies, including this one, our goal is really typically to have a 1% long-term yield advantage over whatever benchmark we're managing to. We did get a little bit of the recent performance from rates falling. We were positioned so that if rates fall, the portfolio will earn its income plus do a little bit better because we believe the Fed was going to continue to cut interest rates. And they have just recently done their third 25 basis point cut in the last few meetings. We do believe there'll be a pause, but they're not done yet, in our opinion. We think we'll see some, sort of the second or third quarter of 2026. So there's a little bit more potential return from a couple more Fed cuts as well. If you look at page 30, the bottom graph, income's important. As Chris mentioned, so is quality. And that bottom graph just shows the average quality over, per quarter over the time we've managed it. So we're in between the AA and AAA type average rating, and that's the way we look at this portfolio. We want it to be, you know, a non-credit risk, essentially, mandate. If you jump ahead to page 31, you get a little more detail on what the different sectors, what different parts of the bond market the portfolio is invested in. If you look at agency mortgages, the third listing, the third sector, it's just under 40%. And again, these are government guaranteed mortgages with very, very short average lives. So we don't want to take the chance that typical mortgages have, where if rates rise a lot, all of a sudden a 1-year security becomes a 5 or 6 year security, which many mortgages that have that behavior. We avoid those mortgages in the portfolio. Chris actually mentioned this too, but taxable munis is another large part of the portfolio. And in that sector, we get basically an entity that has the power to tax. So we're not dependent on revenues in the economy and the power to tax, but also have some very unique structures of bonds that we can get a lot of income, again, with very low interest rate risk. And just one quick example would be a bond, let's say, with a 6.5% interest rate, and it's currently callable. So if the issuer wanted to call it tomorrow, they could. For whatever reason, certain bonds are not going to be called. And so we love to buy these things because you don't have to pay very high of a premium. You can pay just a little bit over par because no one's going to pay 103 or 104 for a bond that could be called in a month. So that's a really good way to get a very high coupon and very low volatility, very low movement in the price of the bonds. And that leads to a much better risk-adjusted return. Again, that's our number one goal. And so there's, you know, you also see closed-end funds, which is just a little bit of a income adder, and that's part of the income portion Chris mentioned. There's just a way to get above market yields and able to buy these things at slight discounts, which actually is another way to add a little bit of return. So you can buy these closed-end bond funds at slight discounts to their net asset value. And then just quickly, I'll give you a quick economic outlook. If you want to go to page 37, you know, essentially our outlook is for the economy to be a little bit slower in the first half of 2026, but not go negative, not have negative GDP. We think the economy will still be fairly healthy. Just is going to decelerate from where we've been the last few quarters, and we see a lot of strength in the second half of 2026. That's what we believe. The Fed will cut a couple more times because inflation will have turned over, and that will allow the stock market and businesses to borrow at lower rates, which will help the economy. We think the regulatory environment will be much different in 2026, which will help companies. And we also believe that just the consumer is going to feel confident again. By that time, they're going to see the higher tax refunds. They're going to see lower withholding with the new tax law kicking in 2026. And we think that'll make the consumer much more confident. A couple of things we do worry about, though, a couple caveats is on page 37. We're looking at credit card delinquencies, and those have, I should say, this is the percent of people making the minimum payment. So these are people that can't pay off their balance each month, and that's a really good indicator of a weakening economy if those numbers jump. Now, the graph makes it look a little crazier than it is. It's only about a 2% jump over the last several years, but it is just something we're watching. So it is something that could change our outlook to some degree. And then the other thing would be on page 41. The other thing that could change our outlook, and that is the amount of federal debt and federal borrowing that's going on. Here we're showing just the net amount of debt, and you can see the change in the shape of the curve, the red line, and how fast the amount of debt is accumulating. At some point, we believe that'll be inflationary, as well as, in particular, hurt the long end of the yield curve if that sort of pace of borrowing and deficits continue. So that also could change our outlook if this accelerates to any degree or doesn't decline. The deficits don't decline a little bit going forward, especially if the economy is stronger. And then on page 42 is just the example of how much the revenues are that the federal government takes in versus their expenses. And you can see it's really, the revenues are quite high, and they've actually had recently increased very strongly over the last 4 or 5 years. It's the big spending problem that we have, and we think that we hope to see that improve. We don't really have a lot of confidence from what we've seen over the last several years. It doesn't matter who's president or in charge, but it is something, again, we're watching. We think at some point that will be a big factor in rates. The good news for this portfolio is that all of these bonds are very short duration, very, 1-2 year type securities. So if the long end of the yield curve gets hurt, that won't have any effect on your portfolio. Is there any questions for anybody?
Yeah, a quick question right here. The Fed chairman's term expires in May, and so with potential new leadership coming in, does that muddy the waters in terms of your outlook, or are you expecting more volatility on the short end until that is kind of resolved, or how are you looking at that?
Yeah, that's a great question. Thanks for asking. We prefer to look at market inflection points rather than calendar year ends, and so we've been looking past the end of 2025 and into the term of the next Fed chair for some time now. We think that the next Fed chair is likely to be very dovish, and that has been our forecast for a number of months now. And so as we've considered what we thought Chair Powell was going to do, our base case was if he doesn't get the Fed funds rate 2-3% by next May, the next Fed chair would get it there immediately and potentially even lower. So that turnover in the Fed chair represents a major inflection point in the sentiment of the market, but not necessarily in the interest rate cycle, because the short end of the yield curve and the short end of the bond market, they're already thinking about where Fed funds is going to be 6 months from now. And the consensus is, given how strongly President Trump has advocated for a dove in that position, that it will be 3%, maybe even lower than 3%. In the commentary in your packet, it shows our rate forecast, and as of October 31st, we thought the Fed would cut rates twice in 2025. It ended up being just the one cut, but the next round of cuts is likely to come fast and furious. And if Powell wants to kind of stand his ground and make the conclusion of his existing term be that he was a contrarian to Trump's preferred rate path, he can do that for 5 months, but it's not going to be enough to change the overall trajectory of rates in 2026, which will be downward by a considerable margin. If Powell holds rates higher in the first quarter, that will just cause more slowing of growth in the first quarter, and it will give more of an opportunity for an acceleration of growth after the new Fed chair cuts them more precipitously.
Thank you.
How fast will that impact the overall economy? Because there's a lot of talk right now about the president's policies won't take effect until next year. Is the Fed chair a big part of that, saying it's going to take off in the interest rate lowering and that sort of thing? I've not heard anybody say what you have just said.
Sure.
So I'm just wondering if that is part of the calculus of the administration, that there's going to be a change.
Yeah, it absolutely is, and I'm happy to hear that you say that our competitors have been saying, because that gives us an advantage. But I would say there are a number of factors that we think are going to drive stronger than expected growth next year, including a discontinuation of pain from tariffs. So as the tariffs get rolled in, they can't cause the same magnitude of an increase in inflation again. It's a one-time change. Trump always has the lever he can pull of reducing tariffs. Given the midterm election next year, if he needs the economy to look like it's accelerating into the midterm elections, he can always reduce tariffs to cause that. That's part of the reason why we also think that he wants rates to be lower, is because we have some strong conviction that as rates come down, it's going to be very, very, very beneficial to growth. If you think about just the average homeowner with their mortgage rate in excess of 6%, a reduction in mortgage rates to 5.5% is going to unlock the opportunity for a lot of homeowners to refinance their loans into a better rate. And that's going to free up a lot more consumer spending, and that's going to improve consumer sentiment. So if it happens earlier in the year, that spreads growth out across the year. If it happens concentrated in May, then in that 3 to 6 month period following May, you generate a significant amount of growth immediately before the midterm election. So at this point, if I'm Trump, I might be sitting here thinking, maybe I don't want Powell to cut, because maybe I want to push those rate cuts a little later in the year to really accelerate growth into the election. I don't know for sure that they're going to be able to game it that closely, but that does give us a lot of conviction that if Powell doesn't cut rates, that it will immediately happen as soon as the new Fed chair comes into place. And I think it would be healthier for the economy if they spread it out. But for us and for your strategy that you're invested in, the income advantage will be there regardless. So the rate cuts will come. We know the direction. We don't necessarily have to predict the timing because it's not going to impact the 1% income advantage that's driving your outperformance.
I appreciate that explanation. That's gonna make me sound a whole lot smarter at Hardee's next Monday morning when we talk about this.
That's my job.
We keep hearing about inflation is beginning to trend to go downward, but my wife continues to complain about what her groceries cost. Is that really happening? The inflation factor going down?
There's a two-part answer. I agree with your wife. I'm probably the most frugal person you're going to talk to today. I know exactly what my family's cost per meal is, and it is not tracking at the price of CPI. Inflation is turning over, and the reason for that primarily comes down to what's happening with the tariffs. And I'm going to tell the worst joke that we have, which is how do you know when you're halfway through a forest? Is because you can't be running into it anymore. Now you have to be running out. And the way that applies to the tariffs is each incremental tariff pushes inflation higher, but it's doing it off of a base that is including all the tariffs that have come before it. Once you reach halfway point of the tariffs, there isn't enough tariffs being added to push inflation higher at a faster incremental rate relative to the ones that have already been onboarded. They started with all the big ones, and now they're just getting to all the little ones. And in some cases, they're actually cutting the big ones. And the way that impacts inflation is it's all the relative incremental change. It's a one-time hit. And as soon as you start cutting tariffs you've already put in, on a relative basis from one period to the next, that reduces inflation. So when we look at the pace of additional tariffs that are likely to be added going forward from here, there's just no way that it can be as large as the ones that were added before. So the period over period change can't continue to grow. So there will still be inflation. It's just growing at a decelerating rate, which market pundits interpret as lower inflation. The absolute price that your wife is experiencing is still higher, but it's not increasing at the same rate as it was increasing last year, and that's considered to be good for the economy.
Thank you.
Other questions? Any concluding comments that you would have?
No, just thanks again for having us, and we really enjoy working with your staff. They're very professional, very easy to work with, and thanks to all of you as well for your time today.
Well, I think the work that you do in maintaining that liquidity, our many members out there appreciate that, especially in December.
Oh, yeah.
When their cost of living, some of them get those checks. I do have one, I would like someone to translate that for me.
Oh, yeah. So that is, the Sit family are Asian American, and our founder was an immigrant who moved here from China in the 1950s. His family fled China to escape communism. So that is the Chinese family symbol of the Sit family, which is where our name comes from.
Okay, next time I see that, I'll say sit.
Yeah,
that's right.
We got it down, okay. We appreciate y'all.
Show it to your dog. Maybe
Yeah.
he'll sit for you.
We appreciate y'all coming and sharing with us today and appreciate your good work.
Thank you.
Y'all have a great afternoon here.
You as well. Thank you. Yeah.
family that your child and your husband's not here? She said, I don't. I said, for Christmas, I want a sugar boat ticket.
Good afternoon, welcome to the Investment Committee of PERS. We're pleased that you're here today. And we have your materials, so if you'll just let us know where you are on which page, we'll follow along so we can mark it for questions later if we have those. And so 15 to 20 minutes, we'll appreciate y'all maintaining that time schedule, and we will turn it over to you all to introduce yourself and let us know what you know.
Great. Well, thank you, Chair McCoy. Can everyone hear me okay, or should I lean further in? Does that work?
You're good.
Okay, lovely. I just first wanted to say it's an honor and a privilege to be here. Gene and I were here 2 years ago at the initial presentation, and we're excited to give you an update on the portfolio. It's a privilege to manage assets on behalf of the state's retirees in the public sector, and so just at the outset, we wanted to say thank you for the partnership. I've met many of you before, but just to introduce both of us, make sure everyone is familiar. My name's Brant Gresham. I've been with Blue Owl for a handful of years at this point. I was at PIMCO before and also had the pleasure of covering Mississippi when I was there. And prior to PIMCO, I was actually in the Navy for about a decade as a pilot. My colleague Gene is the lead portfolio manager on Mississippi's portfolio. He leads all of first lien direct lending at Blue Owl. And he's been with Blue Owl for a number of years at this point, having joined us from Goldman Sachs, where he was running their leveraged finance business for a number of years. So he's been certainly in his entire career kind of focused on the kind of credit investing that we'll talk about today. So to maybe just for 2 minutes give you a situation, situate this strategy in the broader context of the firm. I'm looking at page 4 of the materials that we'd shared. Blue Owl at this point, we manage roughly $300 billion in assets for various types of clients. On the institutional side, by far, the most common type of client that we work with is public pensions, and we're proud to work with them. We basically do 3 things. We do credit investing, we do real assets and real estate, and we do what I would describe as non-traditional private equity. If you look on page 5 of the materials, you can see that the credit business is really the largest part of our business. It's half of our assets. We've been doing it for 10 years. And on page 5, what I would really like you to come away with is a couple of things. Number one, the credit team that Gene is a leader of is incredibly well resourced. We have more than 250 people focused on credit at Blue Owl. And if you're going to do the type of in-depth, weeks-long, months-long underwriting that we do every time we make a single investment on your behalf, you really need to have a lot of people at your firm that are focused on it. It's not just the underwriting leading up to initial investment, but it's also the monitoring of those investments going forward. The second thing I would just ask you to take away is we've been doing this for a long time. So in the kind of direct lending that we manage on behalf of Mississippi, we've been doing it for 10 years. We've been doing it at scale, deploying more than $150 billion. And we have, what we think are really attractive in the sense that they're low loss rates. When it comes to credit investing, it's really all about avoiding losses because our upside is capped and our winners cannot outperform our losers. So it's really all about minimizing those loss rates. And that's a key part of, even within the broader Blue Owl ecosystem, this strategy that Gene manages is the highest quality, the most focused on protecting against downside. The last point I'll mention on page 6, you can see that direct lending, which is how we would categorize the Mississippi portfolio, is the largest thing that we do within the world of credit. But we do also have a presence in other credit markets, and we think that's important because the reality is, as I'm sure you hear from the Callan and Grosvenor team as well, all credit markets are really interconnected in one way or another, and we think it's valuable to have our foot in the door, so to speak, in various parts of the credit market. It helps us inform and make better investment decisions in your portfolio specifically. So I'll stop there and hand it over to my colleague Gene to talk specifically about the Mississippi portfolio and how it's been doing, and then we'll have a few minutes for questions.
Great.
Thanks, Brent. So I would ask you to turn to page 9. And just to orient the conversation, just wanted to provide a bit of background on the philosophy and the strategy that we're managing on your behalf. It's really pretty straightforward and pretty simple. We are lending money to what we call or characterize as upper middle market. So translate that to fairly large private equity sponsor-backed businesses. So fairly straightforward. A private equity sponsor will target a business in which to buy. Historically, and I'm going back 25, 30 years, they may have gone to a bank to seek the financing alongside the equity to purchase that company. And today, very often they will come to a lender such as ourselves on your behalf to make the loan that supports the purchase of that business. Upper middle market, I said, essentially replace large for upper middle market. The way I would think about the businesses that we're dealing with is they're scale businesses. They're attractive businesses that, though privately managed, have some good size to them. And so across your portfolio, you'll see businesses 75 million of operating cash flow and greater. Some of the businesses as large as 200, 250 million of operating cash flow and greater. So large and substantial businesses, as Brent referenced, the winners don't make up for the losers. And so everything we attempt to do is to identify very strong businesses that will be winners in all cases, that will be defensive in all cases. And one way to identify those businesses is to look for the biggest, best performing businesses within their sectors to be a lender to. Our focus on financial sponsor-backed businesses is similarly yoked in being defensive. The idea of having a financial sponsor to partner with, to invest alongside, is really to have someone from a governance standpoint that's focused on the operations of that business on a daily basis, the execution of that business on a daily basis, but also having their capital sitting below us in the capital structure. Financial sponsors are sitting in a first loss position, and very often we're lending somewhere 30, 40% loan to value of the business. Said another way, the financial sponsor would have to lose essentially 60% of the capitalization of a business before we would lose a dollar. We're sitting in a senior secured position, purposely meant to be defensive on your behalf and harvesting the cash flow of that loan that we provide. So a fairly straightforward strategy. There have been no changes to the strategy or our orientation on your behalf over these 2 years, and that will continue to be our focus going forward. Just to simplify it a bit, we have, at this stage, as of the production of these materials, so as of September 30th, 19 positions in your portfolio, close to $100 billion of committed capital. If we roll that forward to today, it's 21 positions in excess of 100 million of committed capital on your behalf. And the types of businesses that we're dealing with are vet services businesses, commercial HVAC repair and maintenance businesses, distributors, manufacturers of gas meters. So fairly straightforward businesses, high quality businesses throughout the U.S. So I'll flip forward to page 11. And if we were to go back to prior pages, essentially the portfolio that we've constructed on your behalf, inception to date, has an 8% net return to the fund. On page 11, what we've laid out is essentially some of the characteristics of what we have within your portfolio. As I mentioned, in February 2024, we started this investment program on your behalf. We've drawn, as of the production of these materials, 37% of your capital. That soon will go above 40%. We have a few deals in pipeline that we'll be drawing down to invest in. And as we look at the nature of the portfolio on the left side of the page here, average position sizes have been just under 5 million. The way to translate that and to think about that as we extrapolate the continued investment of this portfolio, essentially you'll have a portfolio of 50 discrete corporate credits across industry and across really geography to provide you adequate diversification in your overall portfolio. That's what we're targeting, and that's what we're working towards today. As you look at the yield on the portfolio at 9.16%, the way I would translate that is 475 basis points roughly over a floating rate. One of the benefits of this portfolio is you're not taking interest rate risk. We essentially price each of these loans at a fixed spread over a floating benchmark. And so as rates rise, you'll get the benefit of that. In certain cases, as rates decline, that will take away from your cash flow. But what it won't do is have a direct impact to the duration or the interest rate risk across your portfolio. We're not taking rate risk. We're identifying good businesses to loan money to really return that capital back to us and to you. As you look at the portfolio, at this stage, I mentioned 19 positions, soon to be 21 positions. At the bottom of the left side of the page, this portfolio is meant to be fairly straightforward and fairly vanilla. And so as you can see, 100% first lien, so 100% first dollar attach, and sitting in a position of seniority, really capitalizing or securing the loan against all of the assets, both tangible and intangible, for the businesses that we lend to, 100% directly originated. And one of the things that really distinguishes our platform is most of the investments that we make, we serve as the lead lender to. That gives us the ability to, as Brant referenced, diligence those businesses very closely, but also monitor them over time and manage them over time on your behalf very, very closely. A couple of stats that are not on the page that I'll share with you. There have been no defaults in your portfolio. As a result of no defaults, no losses. We have no pay-in-kind instruments in your portfolio, and so all of these loans will pay cash on a quarterly basis to the fund to the SMA, and as a result to your retirees. And as we look at the nature of the leverage and the loan to value in the portfolio, today the average investment in the portfolio is levered at less than 4 times its operating cash flow or proxy for operating cash flow. To relate that to the aggregate value of the business, it's essentially at roughly 30% of the value of the business. So we're lending 4 times through operating cash flow for businesses that are typically valued 12 times operating cash flow. So all of that junior capital would have to be eroded before we would take a loss in that senior secured position. On the right side of the page, we've laid out some of the industry diversification. As you can see, much of what we're doing is focused on industries that we view as having very, very solid demand dynamics. So independent of where we are in the credit cycle, healthcare businesses, food and beverage, infrastructure-oriented businesses, the demand is still there. That's very important to us and very important to you because we want to have as defensive and acyclical a portfolio as we possibly can, and having solid demand dynamics associated with the portfolio investments is a big part of that. One other point that I'll reference is as you look across the various sectors, you'll see the word services quite a bit. So healthcare providers and services, business services, professional services, financial services. The reason I point that out is as you think about tariffs and the impact of tariffs to the broader economy, services-based businesses are not producing something or assembling something that's going over borders. And so the impact to those businesses or direct impact is much more muted. And so as a result, what we've seen is fairly stable performance of this portfolio really throughout the life of the portfolio, but specifically in the most recent quarters where we've seen tariffs as more of a conversation piece across the economy. So I'll pause there for a second and see if there are any questions. If not, I'll turn to pages 12 and 13. And here we just highlight our investment team and a stylized view of our organizational structure. Really on 12 and 13, The sole item that we wanted to emphasize is the decision makers for the portfolio have been consistent throughout. And so it's the same team. Brent referenced a broader credit investment team. The team that we're highlighting here is our direct lending investment team, which is over 125 professionals focused on finding the best companies and underwriting the best companies to introduce to your portfolio. And the consistency that we've had in the decision-making really resides at the top. All of the senior leaders of our business, including our co-CEOs and president and CIO of our credit business, alongside myself as voting members of the investment committee for your SMA. Your SMA requires complete agreement of the investment committee for all of the investments that reside in your portfolio, which we think is really a good focus towards having the consistency of investment that we want in an SMA focused on senior secured lending. So final point I'll land on is on page 15, and then we'll turn it to you for any questions. And really, it's just to end where we started. The strategy is an upper middle market financial sponsor-backed strategy meant for senior secured loans, senior secured investments, meant to be very straightforward, meant to introduce a consistency of current income for you and obviously the beneficial owners of the account. And so with that, we can open things up to any questions that you have around the strategy, any of the investments, and certainly anything we're seeing and how we're positioning the portfolio moving forward.
Questions from board members or staff?
Yeah, recently we saw a fairly high-profile bankruptcy happen, and we didn't have any. Thank you very much. First Brands.
Yes.
Failure on very sloppy underwriting, in my opinion.
Yes.
Failure to see cross collateralization.
Yep.
Just so everybody here can hear your process in avoiding situations like that, what do you think went wrong, and what do you do to stay out of that?
Yeah, and there are a few different levels to it, and you use the word sloppy. I think there's a fair amount of sloppiness in that process, though. With First Brands, with some of the other high-profile bankruptcies, defaults, I think it's a good reminder for us to redouble our efforts from an underwriting standpoint and focus our attention very intently. Number one, as a deal comes in the door, is it a good company? Is it a company that we want to be lending money to? We took a look at First Brands across our asset-backed business, across our corporate credit business as well, and passed on it in both cases. And much of that had to do with the underlying business itself, and so a lower margin, lower enterprise value type proposition. Some of it had to do with governance. Some of it had to do with the opacity of their capital structure, so not having a clear understanding how much debt they actually had outstanding. But as you think about the process steps that would eliminate someone making a mistake on First Brands, first and foremost, it's having the industry specialization to be able to make the assessment of the quality of company that you're dealing with. Once you get to that point, you have to verify everything. And so you get a set of financial statements, and perhaps that set of financial statements was audited. You still want to verify. You can't trust anything. And so in our case, use of third parties to go in and kick the tires and do quality of earnings work, that's a critical part of our process, and validation to that audit that might be there. Even in that case, there are certain times you got to see for yourself. You've got to go out to the distribution sites. I have an anecdote about sitting outside of a theater and counting the number of people walking in early in my career, just as a part of validating what you're seeing in the financial statements. Does it hold? And so That's got to be a part of the process as well. Validation of all of the information that's coming across. And then from there, perfecting your collateral position it's a consequential part of the process. The appropriate filings to make sure you're in a first priority position. There are no other liens against the collateral that you're counting on to as a second form of repayment after the free cash flow of the business. All of that has to be pristine, and all of that has to go through a process and appropriate checks to allow you to know that nothing nefarious is happening. What we tell our underwriters is trust nothing, verify everything. And that's the process you've got to undertake with all of this. Ultimately, we think the part of the pond that we're fishing in is the best part. Larger businesses, scale businesses that have better governance, financial sponsors that have that are very much axed to make sure that financial statement presentation, quality of governance is very, very high. That being the case, we want to validate that every step of the way, every quarter, every week, as we're having conversations with these management teams and just validating what we're seeing with these businesses. And so I think there is, when there is a fair amount of capital looking at opportunities in the private credit space or any space, you can see people cut corners. And to some degree, First Brands, some of the other high-profile defaults have been a good reminder to us. Can't cut corners around these things. You got to be very focused on the blocking and tackling of making sure the underlying companies are quality businesses, but also making sure you're getting the proposition that your investors are looking for, which is a senior secured first priority position in those loans. I don't know if you've got anything else you'd add.
The only thing I'd add is we have the luxury of passing on 95% of the opportunities that come through sort of the door initially. So from our perspective, if there is any doubt, there is no doubt. We just move on to something else that looks more attractive. The only other thing I'd add on top of that is I also think it matters how you incentivize people in any organization. On our team, no one is rewarded for simply originating an opportunity or making an investment. People are evaluated based on the performance of those investments. And I think that cages people's brains in the right way to think, if I bring something up as something we should potentially look at, my reputation, my future, my career is on the risk if I haven't done the homework to make sure this is a real and high quality opportunity. I think some other firms occasionally get themselves crosswise by saying, I need to, my livelihood depends on me originating at least 15 deals this quarter. And that's just not how our firm is set up.
Okay, thank you.
With as much money as going into private credit, can you talk about the level of opportunities that you see coming across your firm?
Yeah, it's a great question. I would make the argument that 2 years ago, had you asked me where would we be at this point, at this check-in in your portfolio, I would have anticipated the deployment would have paced a little bit faster than where we are today. And I think a lot of it has to do with quality of opportunities that we've been seeing. I have seen a bit of an inflection in the most recent quarters. And so looking back over the last 2 years, sponsor-led M&A has been, in 2022, 2023, the beginning of 2024, pretty weak. And from that, call it trough, we've been building up and seeing more activity starting to really come to the market. And we're seeing much more activity in, I'd call it the early stages of our pipeline today than we've seen in quite a while. And so as I think about the opportunity set today, relative to where we've been over the course of the last, call it 18 months, I am cautiously optimistic that we're turning the page to have I'll call it the reconciliation of sponsor capital and desire to put money to work with opportunities and sellers of assets that will allow the M&A environment as we move into 2026 to be as attractive as we've seen from a sponsor-led buyout standpoint, which should provide us with a fair amount of opportunity. We have, I would make the argument, and I'm somewhat biased in this, that we've built a fairly good origination engine and conditioned much of the financial sponsor community to show us their deals as they come through. As Brant referenced, very often we're saying no to them. We're trying to say no early to not waste their time. But what we try to do is condition them to show us everything, and we'll select out of what we do or don't want to do. And what we're seeing in the current pipeline is a nice, I'd say, step forward in terms of deal activity, which should inure to the benefit of just overall deployment in quality situations within your portfolio as well.
Thank you.
Other questions? Do you have any closing comments then?
Just to say thank you. I know we're early on in what's hopefully a several years long partnership, but excited to be here. Looking forward to coming back in 2 years, and thank you for the opportunity to provide this update.
I'm glad that you were able to come down when we were having a balmy day here.
Okay.
It's not cold. We do appreciate y'all coming in and the work that you do for us. So thank y'all so very much.
Our pleasure.
Thank you.
Good afternoon, welcome. We're glad that you all are here today, representing CGM Grosvenor, and we're looking forward for you sharing with us the things that you have been doing for us. Also, we have your information. Just let us know what page you're on. We'll follow along as well. So I will turn it over to whomever, introduce yourselves, and then the rest of the group, and y'all got the next 15 to 20 minutes.
Great. Well, I'll kick us off and introduce the crew here and pass it to them briefly.
Okay.
But afternoon, thanks for having us in. We appreciate the opportunity to give you an update on the private credit program that we initiated together with you back at the beginning of 2024. So we're about 2 of the 3 planned 3 years into the build out of the program. And so the folks to give you the update here, Steve McMillan and Kyle Brennan, both senior members of our private credit team. Steve
spends time in London and in the US for us. So you may remember his accent from last time, still has it. And also a member of our private credit investment committee, and Kyle, senior member of the team as well, working closely with Steve on the portfolio that we manage for you, and works out of Atlanta for us. And Mark, I help coordinate things between our teams. So before I turn it over to them, just two quick things. One, we want to just thank you for the partnership. We really do appreciate the relationship. We enjoy working with your team on a regular basis. It's been great communication, great back and forth on a regular basis, and we're just really feel privileged to be able to help you all serve your beneficiaries and achieve your goals. And second thing, just to help you do that and be an extension of your staff and resources here and other partners, Grosvenor's businesses continue to be healthy. So on page 6 and 7, statistics on the business, but the takeaway is business is healthy. We're on the credit side, continue to see a lot of interest in what we do. We're at $16.5 billion of capital. We've been managing credit portfolios, private credit portfolios for several decades now, and the business continues to grow at a nice pace. So with that, I'm going to turn it over to Stephen Kyle.
Thanks, Mark, and good afternoon, everybody. I still do have that British accent, but it's great to be back in Mississippi for the second time. So thanks a lot for having us. So as Mark mentioned, so the program's been going just nearly 2 years now. And just as a reminder, the role that we're trying to play is really complementing the exposure that you guys have with Blue Owl, which, largely focused on the sort of larger part of the private credit market. So we know Blue Owl well, we know that portfolio well, and we're looking to build for you guys a portfolio that complements that diversifies away from that, but adheres to the kind of core tenants to the mandate, which is focused on senior secured, downside protected, sort of safe corporate lending. And we'll get into the details over the next couple of slides, but didn't want to bury the lead. Really happy to report that it's been a very strong start to the program. The relationship with the staff is excellent, and both initial deployment and initial performance is ahead of expectations. We'll touch on some of that shortly. Didn't want to spend a ton of time on the market, but happy to take any questions. But as we've thought about, how we're seeing private credit today, we still think it's an attractive area for capital and investors like you guys. We are seeing more pockets of froth and competitiveness versus much of the last 2 or 3 years. But this secular change trend that we've seen with banks, frankly, retrenching and sort of private capital sort of coming in its place continues to progress. So we're particularly where we're focused, which is slightly sort of smaller managers, maybe slightly sort of smaller sort of loans, partnering with sector specialists. That area of the credit market has remained relatively inefficient. And I'm sure you've heard from Gene and the Blue Owl team that in the larger part of the market, that's probably the most competitive right now. And we have seen spreads and returns coming a little bit. That's been less impacted in what we're doing. So happy to report that we still see a lot of good opportunities. But that being said, there's obviously been a ton of sort of headlines out there, and we're not being complacent. And I think this is a kind of environment where you need to keep your hands out of your pockets and be very judicious as it relates to making sure that we're extending loans and partnering with people that are extremely high quality, close proximity to cash flows and assets, strong documentation as it relates to sort of covenant packages. All of those kind of 101 blocking and tackling as a credit investor is very important in markets like this, is how we see it. So if you're following on sort of slide 10, this is a snapshot of where we are today. The program is $250 million. We've committed around 75% of that. So we're kind of bang on pace, given we're 2 years into the 3-year investment period, of which about 35% is called. So just a shade over $80 million has been called, and we expect that to continue to call pretty quickly now over the next 3 or 4 quarters. I think if we were to be sitting here this time next year, which my understanding is we won't be, we'd expect to be sort of 80 to 90% called by the end of the investment period. We've committed to 8 funds, which Kyle will give an overview sort of to shortly. So again, sort of in line and on pace to that sort of 10 to 12 that we communicated a couple of years ago, and have also curated a portfolio of co-investments, which is a 15% sort of part of this mandate. Mentioned performance has been very encouraging. Yeah, there's less of a J curve in private credit investing versus private equity investing, but there is some notion of sort of J curve. On a net return, we're just a shade under 10%. These numbers were through the end of Q2, which is what we had as of a couple of weeks ago when we were putting the materials together. We actually did get Q3 numbers a couple of days ago, and I'm happy to report we're continued to be sort of bang on 10%. So both the IRR and the sort of money multiple is above where we would expect, just given that J curve aspect, and it's been very encouraging that we've been able to mitigate that straight out of the gate. But with that, I'll pass to Kyle.
Thank you for having us. On slide 12, we have a quick snapshot of the exposure of the fund. If you take a step back, one of the key tenets and philosophies that we have when we're putting together these portfolios is diversification. So we like to have a lot of different loans, and the goal being there's no single loan or risk factor in the portfolio that is outsized or can kind of generate losses. And so when you look at kind of private credit portfolios, most people in kind of the direct lending world will have somewhere around 100 loans in their portfolio. Some will have less, some will have more. We actually run with more diversification than that in our portfolio. And if you look at it today, we already have over 500 individual loans in the portfolio. So around 200 different kind of corporate loans in the portfolio, and also 300 asset-backed loans that have some sort of kind of hard asset collateral as protection in those loans. If you look across kind of some of the charts on here, we try to diversify by a couple different things. First, by strategy. So we'll talk about it on kind of the next page. We invest in different managers that have different underlying strategies that are not necessarily correlated to each other. We also diversify by vintage. So we're not making all of the loans at once. You're kind of doing it over different periods of time. And what will end up happening is those loans will have different risk characteristics based on when you do the loan. And we're very diversified by sector. So on the bottom right, it shows kind of the individual kind of sector diversification. There's no kind of one sector that is a kind of majority part of the portfolio, and we have exposure to a large amount of the overall credit markets. Going on to slide 14, we have a quick kind of portfolio summary of the investments that we've made so far. You'll notice there's 7 what we call kind of primary fund commitments, 4 of which were made as of kind of the 6/30 date of the portfolio, 3 which are at kind of the bottom, which happened in kind of Q3 and Q4 thus far. As you think about kind of what those funds are and how we're a little bit kind of different and complementary to kind of Blue Owl, there's a couple of different kind of buckets and themes in the portfolio. The first is funds where we leverage our kind of relationships with managers and our kind of large capital base to get revenue shares in these businesses. So 3 of the investments that we've made actually have you receive a share of all of the fees generated by those managers. And so what that ends up happening is if we invest in a fund, let's say the fund has an expected return of 11%, we actually expect that your capital will generate a return that can be 3 to 5% higher because you're actually generating and getting a piece of that fee revenue. And so in most cases, you are in a situation where you're expected to pay fees to managers. We actually have a situation where we're actually getting paid by these managers to provide kind of large capital investments and strategic capital investments. And this is a thing we've done for a long time to kind of generate kind of extra returns through our kind of size and scale. And if you actually think about Blue Owl, kind of your other allocation, we were actually an early investor in Blue Owl, and some of our early capital we invested there had a revenue share that was very beneficial to our capital. And so it's a theme that we've continued to do and has generated kind of excess returns for our clients, and one that we think is a kind of an interesting theme, and I think we'll continue to do moving forward. We have 2 funds in the portfolio that we call non-sponsor focused. So if you think about what Blue Owl focuses on, they focus on very large situations where they're providing loans to companies that are being bought or owned by private equity. We have 2 of the investments in here that are focused on smaller situations where private equity is not involved. There's a lot of reasons that we like that space. One of the reasons is you typically see a kind of small return pickup in what we call non-sponsor versus the private equity deals, because it's less competitive. The other thing we often see is kind of better protections and covenants in those loans. Because they're less competitive situations, we think you can get actually better downside protection through structuring of those loans. We have one sector specialist in the portfolio today that focuses on healthcare, where we think there's kind of interesting kind of tailwinds and excess returns because of it's not a very competitive space in the private credit. And we have one fund that focuses on asset-backed credit, mostly within an investment grade, so it's very high quality. Think of it as someone that'll buy pools of U.S. residential mortgages as an example, which is a little bit of a kind of different strategy than the corporate. But the reason we like it is it's very diversified, and we think there's significant downside protection in those loans. So if you think about the kind of the typical investment in that part of the portfolio, think about a house that's worth $100,000. There might be a $60,000 mortgage on that house, and we're kind of partnering with managers to buy that mortgage and own that mortgage. What we like about that in today's environment is there's significant equity subordination below us. So even if you think about a downside scenario of a GFC type losses where home prices go down 25%, we still have significant cushion in what we're doing where, even if a home price goes from 100,000 down to 75,000, we have a loan that's worth kind of $60,000. We're very well protected. And one of the places we think there's actually excess return in the markets today is in those asset-backed loans versus some of the larger corporate. So that's one of the allocations. And in the mandate we have today, we have kind of 20% bucket that we can do some of those asset-backed loans. We've done about 10% of the portfolio we have today.
Maybe just to wrap before questions, I think Carl mentioned some of the revenue shares, but we have a very keen focus, obviously, on fees. That's the only sort of known certainty. Paying less fees is better. Every allocation that we've made of the 7 either comes with that revenue share component that Kyle mentioned. The other 4 that don't, we have significant fee reductions. So we charge an effective fee on these primary investments at Grosvenor level of 27 basis points. Our average fee saving for the allocations we've made just by being able to negotiate with Grosvenor scale is 75 basis points. So almost 3 times the fees that we charge. We've managed to offset with fee negotiations. There's additional fee savings on performance fees to the extent there is any. But that's something that we've been very sort of focused on over the last couple of years, and hopefully agree that's been a good result, 75 bip savings. That was it as it related to prepared remarks. Obviously happy to sort of take any questions.
Questions? Charles? Colin? Anything over that way? Any over this way? I don't see any questions coming from here. Do y'all have any other final comments you'd like to share with us?
We just really appreciate the partnership. I wanted to fly out here from London to see you guys in person, given this is the first one since we've kicked off. Like, the team's works super hard and is super motivated, so thank you very much.
Very good. We thank y'all for coming and sharing with us the work that you're doing for us. Continue to do the good work. Looking forward to seeing you the next time you come to Mississippi. Hope that we're all here, able to welcome you. So, y'all have a great rest of the afternoon here. Thank you.
Thank you very much.
Thanks.
This updates, okay?
not really any direct impact to any of our portfolios, so that's very loud. The only one that we have is Peter Palfrey with Loomis has announced that he is going to retire. We are not concerned because the co-founder, Rick Rakowski, is, still managing the strategy. And outside of that, Dimensional Fund Advisors sent us a notification about some changes in their global research platform, but it doesn't really have anything to do with our portfolio, as it is a domestic portfolio. And unless there are any questions about these updates, I am done.
Any other questions about the update? Mr. Higgins, anything that we need to share?
No, sir.
10 o'clock tomorrow morning?
9 o'clock.
The investment committee is adjourned.